Thanks for coming along. This is a lovely cosy room, so we're not using mics today, just as the phone goes off. It's quite a nice close group today, so if you do have any questions, obviously we'll, at the end of each presentation, we'll see if there's anything I want to ask, but if you have something mid-presentation, presenter's going to hate me now, but shove your hand up, ask the question, and we'll have a chat as we go. David's like, oh please, for goodness sake. Structure, Gareth, structure. Today we are recording the session, so you'll see me wandering around with the camera and a few bits and pieces, so it will be available to you afterwards as well as the presentation materials, okay? But like I say, thanks for coming along. Yesterday we were in London at the Law Society. Very different venue today, and what a beautiful place. I'm glad you found it here okay. We struggled a bit this morning. And then tomorrow we're in Aberdeen, so if you've got any colleagues that wanted to come today that may be in Aberdeen, they're welcome to do so. So my name's Gareth Hector, I'm Head of Marketing at Westwood. You'd have had emails from me reminding you to come, so thanks for being here. Quick disclaimer, which is on the wrong page, so talk amongst yourselves, 20 seconds. It's a normal disclaimer with the type of information we're going to show you, just about copyright and such. Presenters today, obviously I get to choose my own picture, but I'll give you a very brief bio of each person because I'm aware that many of you don't know us, and certainly as individuals may not have met us before. So just to give you a brief intro to who is speaking. I've always introduced myself. We've got Tom. Can I not find you? There's only so many people. Tom's at the back there. Tom's one of our exec directors. He heads up our consulting division, and he's essentially a key stakeholder in our offshore energy services area. Tom's experienced industry consultant and provided market, commercial and strategic advice to support over $18 billion worth of M&A and debt financing activities. Over the last 20 years, and that includes the ADES IPO and the recent Carlisle acquisition of the FPSO vessel business of Altera. Graham completed his Masters in geophysics at Oxford, and then went on to hold a number of positions during his 30-year career with BP, including E&P technical positions, and involved in a number of key discoveries and FID. Graham joined us as Global Head of E&A in 2019, excuse me, and Graham leads the Wildcat team, responsible for producing really deep technical insights to help companies understand their E&P and appraisal performance and how to improve it. Teresa. Teresa's our Research Director for RigLogix, sort of quite a descriptive name in terms of what it does, but Teresa's focused on tracking and analysing the offshore rig market. Over a decade of experience as an analyst and project manager in the energy industry. So Teresa brings a huge amount of expertise from her time at previous roles as well, at IHS and SGN as well. David Linden, right at the front, familiar to Edinburgh through his previous roles, but David is also one of our exec directors and currently serves as Head of Energy Transition and EMEA Consulting. David also has over 20 years of commercial experience in global energy value chain, including roles prominent organisations such as Chorus, BP, McDonald, and of course Wood Mackenzie, hence Edinburgh. And then finally, but no means least, Yvonne, where are you? Back there.
Doesn't look like that. Just to confuse you.
Yvonne leads our North West Europe team and is focused on commercial analysis for that area. Yvonne's got over 30 years experience in the oil and gas sector and working in supply chain operations at E&P companies. Prior to Westwood, Yvonne was also at Wood Mac, but her early career was spent in production chemistry, working in the service sector and for Apache before moving into production engineering. There's a few of us. Emma is also here, Emma heads our sales, and Barry, who you may have seen on the way in, and now he's there. Thank you. So there's a few of us here today. By all means, just grab us for a chat at any point. There we go. Um, today's agenda, you all here, I think you know what we're going to talk about, but 2 sessions. We've got a shortish lunch break in between, so it's just be a light lunch, half an hour or so. Like I say, we're cognizant of your time, thank you for coming, but we'll try and keep very flexible in terms of questions and such. And then after lunch, we follow up again with sort of the UK Outlook, decommissioning, and then the UK ET follow on. Usual housekeeping, just the main thing, there's no fire alarms due. If you hear one, you should react appropriately. The Wi-Fi code, you can just use your PIN, your phone number, and it will send you a PIN to access. There are some feedback forms out and there'll be a QR code. It's really useful for us to understand what's of value to you and what you'd like to hear more or less of. We'll put those out towards the break. It's the last slide from me. We've got a lot of lovely messaging that I want to convey to you, but in essence, this is Westwood. Okay, 3 core things that we focus on: quality, specialisation, and flexibility. As a market analyst, flexibility may not be the first thing that pops to your mind, but if you think about pandemic, recent politics, geopolitics, where we are with exploration and energy mix, being flexible, being dynamic, challenging and being responsive is a core part of what we do as market analysts. And it's important we listen and take questions, and that's why that's one of our 3 core areas. Now, as a business, we're operating across the upstream energy sector into these specific areas, and you're going to hear a bit about each of these today. But they are all served by individual solutions. There's some literature out. We can show you some stuff online, whatever you need and want, really. But this gives you an idea of breadth and depth. And that's all underpinned by Global Energy Consultancy, which Tom leads and David covers for Europe. Happy to talk about any of this in more detail. But what you're here for. Tom, can I invite you to the floor? Thanks, everybody. Enjoy the session.
Thank you, Gareth. Can everyone hear me? We don't have microphones, so if you can't hear me, put your hands up. I think as Gareth mentioned, we're here for you guys, because we already know all the content. So if you have any questions, group this size, put your hands up, we can chat it through. Some of the text is a little bit small as well, the text and the charts, so if it's like, oh, what does that mean? Just make sure you ask, right? That's we'll get more done. So I'm Tom, I run Westwood's consulting business. I'm based out in Singapore. I also provide leadership for our energy services, research and analytics. So that's the entirety of the supply chain servicing the energy sector. And my role today is a bit of a scene setting, talk about the high level themes and trends that are shaping offshore energy today and potentially over the next 5 years. We're going to talk about some of the challenges and headwinds that the sector's facing. You know, offshore, oil and gas in particular, and wind, they had a pretty good run for the last few years as we came out of COVID, but we are now seeing some significant headwinds that need to be addressed. We're going to talk about those. We're going to talk about how European super majors are adjusting plans in light of that. We're going to talk about our outlook for activity and investment levels for global offshore energy. And then we're going to talk about some of the existential challenges that the supply chain is facing as well, and how we might think about maybe fixing those. So to get straight into it, I'm just going to move this as well, so I don't have to keep turning around. Oh, is it going to? Sorry about this. It's not behaving very well. Okay, well, I'll just turn around, right? So what we're talking about here is the short-term supply and demand in the oil markets. And those of you who track this kind of thing will know that as we kind of moved through last year, there was an increasing concern over the short-term and mid-term demand for crude oil. And this is for myriad reasons. These include faster than expected energy policies, particularly in Asia. We saw a rapid acceleration of the uptake of electric vehicles in China, but perhaps more structurally important, which we didn't expect, was the rapid uptick of the use of LNG in long-haul trucking and commercial driving, which has effectively led to a peak already in Chinese diesel demand. And it's this kind of stories coming out that have caused a few ripples with regards to confidence in growth in oil demand. And what we've plotted on this first chart is the impact of that. We've used the two most kind of subscribed to views on oil demand in two separate camps, which increasingly bifurcate over time. We have OPEC and their view on oil, and we have the IEA and their view on oil demand. And of course, they have very, very different narratives and different policy objectives, I suppose, of when they put this information out. But the trends are very similar when we look at these charts. What we've effectively done is look at their oil demand stories in this thick line. So the green line for IEA, it's August 2025, most current view. And for OPEC, the thick line, August 2025, most current view. And we have these dotted faint lines, which is what they were expecting at certain past intervals. So you can see from May 24 onwards, effectively, they have been revising down their expectation for 2025 crude demand. And it's off the back of these kind of narratives we've talked about, a slowdown in China, which for so long has been the main growth engine in the oil market story, and other factors as well. We've seen slower than expected uptake, slower than expected driving seasons in the US, etc. as well. So fundamentally, we have this backdrop of a softening in expectations for oil demand over the next 12 to 18 months. But then when we look at the supply side, unfortunately, that is compounded by a rapid increase in supply. So what we've plotted here on the right-hand side is since April 2023, the net change in oil production. And we've just used the major movers in this market. So it's not global, but this really does show what's happening in the oil supply market. So, of course, many of you will know that OPEC Plus or the DOC have been intervening in oil supply, taking barrels out of the market to keep markets balanced. And the introduction of 2.2 million barrels a day of voluntary cuts came into effect around April 2023. And that is shown in these green negative bars. So those are the barrels that OPEC Plus has taken out of the market effectively. You can see around 2.2 for most of 2024. But conversely, we've seen the international market increase their production. So we've looked at the main people who are driving supply growth. That's US liquids, which includes NGLs, it's Iran, it's Brazil, and it's Guyana. These are the major countries that have been adding supply. And you can see that for most of 23 and 24, this red line is the net impact. The OPEC Plus voluntary cuts have done a pretty great job in keeping the market balanced and offsetting that incremental supply. So that red line, I'm not sure if the pointer's showing up, but that red line has been really at zero for most of 2024. However, as we moved into this year, of course, the big announcement that those 2.2 million barrels are being rolled back and putting into supply, where you can see the impact. We've already had a significant increase in OPEC production as those green bars move towards the zero position. And the net impact, that red line, means that we've effectively added just shy of 3 million barrels a day since the beginning of the year. So when you combine a weaker than previously expected demand story with a rapid increase in barrels, of course, you're in a position now where the fundamentals for the oil market look a little bit shaky at best. Brent currently under $70 a barrel, and most analysts and banks revising their next year outlooks to 65 or below. So what do we think that mean going forward into next year? So what this first chart does is, again, you're probably quite familiar with charts like this. This is our take on it, is global supply and demand balance. So the orange line is the global liquids demand quarterly. The green line is global liquids supply quarterly. And the blue bar is a result of that. It's the over-under, the supply, the draw or the build position. And again, you can see for 23, 24, it's generally been a balanced market. If anything, we've been in a undersupplied position, which has been supportive of the kind of $70, $75 Brent price. But all things considered, if OPEC continues on its current policy of rolling barrels back, when we take into account seasonally low demand in Q1, demand is always slower in Q1 relative to summer driving seasons, we expect a substantial build-up in oversupply in the first few quarters of next year. And that's generally being reported by most analyst houses. So unless anything changes on the supply side, we're looking to have a majorly oversupplied market in the first half of next year. And of course, that will put additional pressure or downward pressure on the Brent barrel. That will start to work itself out over the course of 2026 as demand starts to improve seasonally. But again, it's that next kind of 6 to 12 months that we're a bit concerned about. And how does that impact prices? I'll stress that we're not really in the game of forecasting oil prices at Westwood, but we're very much in the game of forecasting levels of future activity. And to do that, we need to have a reference price. So you can see here, this chart, this is plotting the Brent barrel over time, and you can see that kind of diminishing value over 24 and the back end of 2024. We have revised down our outlook for the first half of next year to around $65 a barrel, staying around that range before kind of picking back up to $70 in 2027. When we think about expectations in the wider industry, what we've taken here is BP and Eni's expectations back in Q1 for their Capital Markets Day, and you can see that they were both in the $75 to $80 range. Now, Eni have already come out in their 2Q reporting and saying we've actually had to revise down some of our capex expectations for the balance of the year because crude is not performing the way we expected it to. So this lower crude barrel is already having some impact on the upstream story. Now, of course, with oil prices, it can change on a dime. We've seen that recently. We are very subjected to certain geopolitical tensions at the moment. When we think about the upsides, there's tensions in the Gulf with the recent strikes in Doha. Could we see a closing of the Hormuz Strait, which of course leads to a spike in prices? Could we see increased stricter sanctions on Russia and Iran, again limiting supply and upward pressure? And could we see OPEC return to intervention to keep the barrel at a $70 range? Of course, there's also downsides, further weakening of the demand story, accelerated ET policies, and impact of tariffs, which we believe have yet to fully be materialized, and potentially OPEC changing its strategy the other way, going after market share and pumping even more barrels into the market. So, general, of course, there's always uncertainty here. You can see the range in that light blue is quite wide, but the general view here is that we're revising down expectations for the Brent barrel in 2026. So the next slide is around how are European super majors adjusting to this new reality. So what we've done is pluck out some of the kind of choice conclusions from capital markets days, which typically occur in the first quarter or the first few months of the year. This is for BP, Shell, and Eni. And there are similar trends running through these. If you look at kind of the strap lines, a reallocation is a word that comes up over and over and over again in all of these capital day market strategy plans. Reallocating priorities, seeking growth, high-grading opportunities. So whilst decarbonisation remains a core fundamental strategy for all of these companies, we would say that the journey is changing slightly in the way that we want to get there. And when we look at BP and Shell, very similar themes running through what they're trying to do. There is an increased focus on upstream oil and gas and the returns that generates. So BP announced a radical shift in its overarching policy, and you can see from its previous guidance for oil and gas capex was 8.5 billion per year over 25 to 27. That has now been increased to around 10 billion a year for 25 to 27 of high-graded, high-value projects. Conversely, for the transition business, we see a previous guidance of 7 billion being reduced to 1.52 billion. My colleague David Linden will talk in a lot more detail around some of the details around what's happening here, but these are the fundamental high-level policy announcements that these guys are going by. With Shell, it's a similar story. An increase in overall capex expected per annum for the 25 to 28 period in that first chart, but when we look at the composition of that, integrated gas and upstream, that's the yellow series in the middle chart, that increases from 55% of that spending for the last 5 years to 60% for the next 5 years. Conversely, for renewables, the blue series, it shrinks from 10 to 9%. So similar trends. Eni, bucking the trend a little bit, one of the few of the super majors who are expected to increase their capex on renewables, but also have significantly increased their oil and gas production guidance. So again, increased focus on these high-graded projects in Indonesia and in West Africa that are expected to fast-track and bring to production. But across the board, similar terminology, reallocating priorities, improving structural costs, so reducing structural costs and optimizing operations. This is really the kind of the key terminology that's being used across the board. So whilst we expect something of an uptick in spending and activity here, again, this is going to be really kind of contained to the highest opportunities and reducing overall costs to improve cash flows. So what does that mean for the overall outlook for spending in offshore energy services? So we track every single oil and gas project opportunity, every single offshore wind project, and we also track all of the offshore carbon capture and emerging hydrogen projects as well. And when we look at EPCI investment, which is a like-for-like spend, this includes all of the expenditure on infrastructure. So this is floating production, fixed platforms, pipelines, subsea, turbines, substations, etc. So all of that kind of equipment we can see that, first of all, there is a kind of a rapid increase in spending expected over the next 5 years. From 2020 to 24, we spent 437 billion globally. We expect that to increase to 682 billion. So a massive ramp up in the overall levels of spending in offshore energy services, and the composition is also changing. If we focus on oil and gas, we've talked about a sustained level of activity despite a weaker Brent barrel. Over 25, 26, 27, 28. That's the dark blue series. So we're not expecting significant growth in oil and gas spending, but a sustained level of activity from what we've seen over the past few years, which is pretty high, to be honest. It's quite a lot of activity. Over the past 5 years, that was 59% of spend, but that will shrink to 40% of overall spend because offshore wind, despite all of those commercial headwinds we hear an awful lot about in the press, huge volumes of work to be done. And again, my colleague David will talk at length about that and the reasons why, but offshore wind going from 40% of the total spend to 58%. And in the background, we see a realization and a maturity of offshore carbon capture projects, which are becoming a real commercial alternative for the supply chain in terms of opportunities to go after. So good news when it comes to levels of activity and volume of work in offshore energy. But of course, there are some significant challenges behind the surface when we think about things like pricing and oversupply. And when we go back to what we were talking about with the super majors and the focus on reducing structural costs and improving cash flows, this chart really indicates the reasons for that. So what we've plotted here for a number of super majors is the cash flow from operations, or OCF or CFFO, however you want to call it, per barrel, oil equivalent, and the unit cost per barrel produced as well for these guys. And you can see the trend, the themes don't look good. From 22 to 24, the OCF per barrel has shrunk by 36% for that group, so they're making less money per barrel. At the same time, the cost to produce those barrels has increased by 12%. So realistically, you have this double whammy of lower oil prices and increasing industry costs, which are shrinking the margins of the super majors. They have less money to spend on projects. They have an ambition to produce more, but they have less money to do it. So they have to do more with less. And really the way to do that is to really put downward pressure on your supply chain to a large extent and to bring that pricing down. And we've already seen that to an extent. This next chart plots upstream cost index. This is the cost of effectively, to hire rigs, to hire vessels, to get FPSOs, to build equipment. It's the entirety of the upstream industry with a cost index, which is a nice summarized way of looking at it. And we can see that as we kind of move through the last few years coming out of COVID, the cost of equipment and services has increased massively, almost rivaling what we had in 2013, 2014, which was a high point for the sector. Unfortunately, in this 2013, 2014 period, we had a Brent barrel averaging $110 a barrel. Right now we have it at 65 to 70, so something has to give. My colleague Teresa will talk about the impact of this and how this has delayed a number of project decisions. But the result of that is really that we are seeing costs in supply chain come down quite rapidly across the board for most products and services. And we expect 2026 to be a continued examples of rigs, FPSOs, marine equipment, increased pressure on pricing for those prices to come down even further. So when we look at from the supply chain point of view, what challenges does that pose? Now, of course, making less money is a challenge in itself, but there is this existential threat, maybe that's a bit dramatic, that is facing the offshore sector, which is the rapid aging of the assets that we need to find, produce, and maintain offshore production. So what we've done is pull out the key assets that do this. So this is the drilling fleet, jackups, semis, drill ships, the marine fleets, the anchor handlers, the platform supply, and the subsea support, the ROV support, the dive support, and also WTIVs in the wind sector. And what you can pull out here is we already have a pretty old fleet. We have an average age for a lot of these assets that is over 20. For jackups and semis, the average age currently is 22 years. For anchor handlers, it's 19 years, for example. For dive vessels, it's 20 years. So we already have a pretty old fleet. And because we build in cycles in this sector, when things click over a certain age bracket, because a lot of operators do use term limits, it all happens at the same time. So when we think about 2030, what that age is going to be, we can see that suddenly the percent of the fleet that's over 20 years increases dramatically for jackups from 35% to 51%. So for jackups, semis, anchor handlers, and subsea support, over 50% of those assets effectively will be over 20 years of age. That means that they are less operationally efficient. They do the work in more time. It takes them more days to do the work. They're more expensive to run. And of course, their carbon footprint is a lot larger than new vessels as well. So when you have a E&P sector that's looking to reduce pricing, but is also focusing on trying to reduce its carbon emissions and improve its operational efficiency, we need a younger fleet to do that, to help deliver that vision. And with increased pricing pressure, these guys already struggling to replace their fleets, it looks like that's going to be very hard to achieve. So the need for collaboration is going to continue to grow. You know, we've estimated that to bring these percentages in 2030 back to where they are today, it's around $66 billion of investment. So a pretty hefty shopping bill to reverse the trends and allow us to be as efficient and low carbon as possible with our offshore operations. And I think that's all from me. I might have gone over slightly, but if there's any questions from anywhere, I can take them now. Yes?
Can I just check when you say global offshore, are you including Chinese assets?
Yeah. In this one I am, yeah. We don't always, it's a great question. We do track the mainland China market out of Singapore. This does include it. Hi.
Hi there, I'm Neil. Maybe David will cover it later. The majors are cutting spending in offshore wind, amongst other renewable sectors, but you're looking at a $250 billion increase in spend between this period and next period. Who is spending that money?
Well, David, feel free to jump in.
Yeah, thanks. So obviously there's spending that's ongoing, but the biggest spenders out there is RWE, Total, Geonex BP, there's still some oil and gas companies in there. But actually the rest of it is essentially utilities. Utilities are very much focused on it. Right? We're delivering a lot of large-scale projects in the UK, Germany, places like Poland as well, actually. So it's
Again, not to steal your thunder, but can the supply chain, which is already super constrained, like, is the availability there to enable them to spend that?
well, so I just sound like we should definitely talk about this later. But no, so ultimately that's obviously been one of the biggest questions. And one of the benefits of a market that's slowed down and has been more realistic means that you actually have more capacity available. And so you actually have, in theory, a better position than you were 3 years ago in terms of what you can deliver. So there are always constraints, there are always issues. Where the turbines come from, where the vessel's going to come from, etc. But actually where the market is right now, it's in better shape than it was 2 or 3 years ago.
Yeah, it's a key point that the expectation is less, which helps that supply chain constraint.
Yeah.
On the original forecast we had a couple of years ago, today you say no way.
Yeah.
Today it looks a bit better, but the biggest challenge the offshore wind sector is facing with the initial build-up coming out of COVID, it could leverage very low pricing in oil and gas to use shared assets, which it is completely reliant on still for a lot of the operations. What we've seen now in oil and gas is that those prices are right up to where they were 2013-14, and that's a huge shock suddenly for a lot of developers. And conversations I have with people saying, well, in 21, I went to get a boat and it cost X, and I went back to use it again last month and suddenly it's 3X. You know, with the margins in offshore wind, it's just not viable. So that's one of the biggest challenges, is not being able to rely on the shared asset base in oil and gas and to build out its own. The other issue is we funded a whole new fleet of WTIVs for the 14 megawatt turbine build out. As we move to an 18 megawatt turn out, do we need to now build a whole other fleet again or modify the existing fleets? That's a huge amount of money to spend in a sector that is almost really struggling to generate cash. Hi.
So I'm not an oil and gas person, so where does gas sit in this?
From which perspective?
Within the sort of, so you were talking specifically about oil.
Yeah, it's a fair point.
Whether gas is included in that conversation, or is gas a separate?
Yeah, that's a great point. We use oil because oil is always that leading indicator for activity. You know, gas is a lot more regional. It's a bit more. It's not as directly linked to activity, but it is important. You know, I think obviously when you look through the narratives and the stories being built by the super majors, there's a huge focus on gas, to build out gas, and Shell in particular to focus on LNG. We're really moving back to LNG as a bridging fuel, which we probably discarded a few years ago. That story is really front and center now. There is concern in the LNG market. There's huge build out, but there's huge investment across the board in the US. There's capacity being delivered every day. in the GCC with Qatar, UAE, and probably Saudi Arabia as well with Jafurah. Huge capacity build-outs, Southeast Asia now with what ENI wants to do in Indonesia. There is export capacity being built everywhere in LNG, and we are expecting a massive overhang or oversupply or structural oversupply of LNG going forward, which is going to bring down pricing there, particularly for spot cargoes, which have been a real issue, I think, for European consumers.
Tom, earlier you talked about how the demand view on the liquids in the short term has shifted, essentially demand erosion. How does the likes of the IEA, OPEC kind of view the world, at least on the liquid side, 2030, 2040? How does that change?
Very differently is the quick answer there. So OPEC's general view is it's not going to peak. There is no peak. The rate of growth will slow, but it will never affect, it won't reverse in the next, at least to 2050. So if you look at the first, what I didn't actually talk through, and you guys will have all these slides so you can look through it and ask questions later, is the long-term expectations for oil demand. So you can see OPEC just continuing to grow to 120 million barrels a day. How do we find and deliver an incremental 15 million barrels a day? That's a huge question, incremental barrels. And the IEA having that peak around 2030 and then dropping to 101.7. So very different views on the world, and it's all around efficiency of usage. It's around the rapid uptake of ET policies such as EVs as well, and how that's going to impact things. I think those are two of the largest differences in opinion between the two organisations.
You just very briefly were saying that the IEA, of course, has now come back with its old current policy scenario back into play as well, because the world is changing so much. And if you assume that countries don't implement the policies that they said they would, you can be in a world which is a little bit closer to your OPEC world. So essentially, like for like, OPEC, IEA, there is a similar scenario that exists, but it assumes zero action. Right? So everyone needs to discuss that amongst themselves.
I guess the point is when we say zero action, there's two other fundamental differences here, right? And if you hear the IEA talk, they do talk around carbon capture and its role. And OPEC are very much, along with a lot of American super majors, believe carbon capture is the solution. The problems aren't the barrels of oil, it's the emissions. It's basically what they're saying. So when we can remove the emissions, we solve the problem. IEA's, along with a lot of the European super majors, is a lot more around, no, we just need to move away from the molecule and towards the electrons. So there are two different policies, but if anything, we're starting to move more towards the former story, I would say.
I have so many questions, but I'm keen to let some of the presentations following answer them. Because I think it's a really interesting discussion around future pricing and investment in oil and gas that's shown in your slides, and potentially what that will do to price going forward and what that cycle looks like. I'll park all that for a moment, but expect it later on. For me now, I'm listening at your slides, I think the most interesting for me was, particularly in Asia, those growing economies, you're picking out particular energy transition trends that you're saying materially affecting this chart. And that's really surprising. So I guess my question is, do you have a feel for per capita consumption profiles in Asia, America? Are we seeing per capita consumption of oil and gas almost kind of leapfrog to an energy transition state rather than following the traditional sort of development trajectory?
Yeah, the difficulty with that is the outsourcing of oil, right? I mean, a lot of Western states were very loud talking around their reduced oil per capita consumption because they outsourced it to Asian manufacturers, right? So there's always something behind those numbers. I think what you're seeing is China claiming it is going to peak its oil consumption before 2030. The likes of Sinopec have been very vocal. That is what's really caught people out because China has driven oil demand. When you talk to oil bulls now, India, there is more and more focus being placed and more attention on the Indian growth story. And unfortunately, that is not as stable or robust a demand growth story to pin the hopes of future oil demand on. So that is what is driving a lot of the uncertainty, I'd say, going forward. If you read a lot of the oil demand stories, it is non-OECD Asia driving growth. So that is India, it's Indonesia as well. It's these large populations which are going to go through massive modernization. But again, the likes of Indonesia, Philippines, huge populations, huge economic challenges. The geography in itself, archipelagos, makes it very difficult to actually have the same rate of growth as we've seen in China. So yeah, I think we're struggling to build a narrative as robust as the Chinese GDP per capita consumption.
Really, really interesting to look at things like Pakistan's adoption of solar in the last 2 years.
Sure, absolutely,
Like,
yeah.
It's next door.
Yeah. Yeah.
Thank you.
So I'm aware that I'm completely destroyed the agenda timing,
Sure.
so thanks for the great question. If we can move on, then we'll take some more.
I'll pass on to Graham. Yeah.
Yeah.
Sorry.
Thank you, Tom. Great, thank you, Tom, for a fabulous introduction. I've heard this now twice, and I'm learning stuff every time I hear it now. And I think today, what we talked about this earlier on, is that we're building a jigsaw now. I think the chance now of what you'll hear today, to hear different perspectives, all painting a part of the same picture. And by the end of it, we'll have hopefully I will have, and you will have too, a far more integrated view about what's happening in this whole landscape. So I'm going to build now on what Tom said and say what the implications might be for exploration. I'm an explorer by background. Just for curiosity, how many people in the audience today have got some kind of background in hydrocarbon exploration? Oh, that's good. That's pretty good. That's nearly half the room. More than I thought. That's great to hear. So the bad news for the explorers in the room is that I'm not going to show any seismic lines today. The good news for the non-explorers in the room is I'm not going to show any seismic lines today. But what we are going to do is talk about very much about building on what Tom has been saying about the whole macro context, how that translates into the landscape for the exploration companies across the globe, mainly focusing on the IOCs and the NOCs. Then we'll go back and look at what's been happening on the ground in terms of exploration activity and performance over about the last 5 years, and what that might mean for the future. We'll then go and look at kind of what's happening in the whole company landscape. Again, maybe dominated by the IOCs and the NOCs. We'll look at that in more detail later on. And then what the implications are for those changes in the outlook for exploration over the next period. Now thinking again about what we mean now in terms of the medium term, roundabout from where we are now, mid-2025 up towards 2035, 2040 kind of period. And the challenges which we face on that going forward. So similar slide to the one Tom showed in many ways. What we've got now is a chart showing the solid bars represent the number of high-impact exploration wells drilled globally over the last 15 years, back to 2010. And a high-impact well for us is a well which targets a pre-drill volume of around about 100 million BOE or more, or is some kind of frontier play test, i.e. trying to open up some new geology for exploration later on. So on top of that is the Brent oil price. And you can see what we've done now, and I think it actually correlates quite well with the slide that Tom showed, is we've divided the world into 3 5-year periods. Now the first period there from 2010 to 2014 was very much, if you like, the good old days, the old normal, when we had a pretty good correlation between high levels of activity, high costs and high returns to the service sector, as Thomas suggested then, and a lot of exploration going on. Then we went through the crash in 3Q 2014, around about, well, say 11 years ago now, and we saw what was often described as the lower for longer period at the time. I think people expected the oil price to remain at low levels and activity to be cut back to low levels going forward as well. But then you can see that the oil price started to respond, and then consequently, what we saw in 2019 was some kind of green shoots of recovery in exploration activity. So the number of exploration wells being drilled going up. But then, of course, again, the world changed at the end of 2019 going into 2020 people often forget it was a brief spat between the Chinese, the Saudis and the Russians on oil price. And then that was very rapidly followed by COVID, which came in early 2020. And the drop in demand that went through and the impacts on the price through that. Then into 2022, of course, we had the Russia and Ukraine incident. And then we've got a number of other factors impacting the whole geopolitical context in which we operate over that period as well. And hence the title of today's talk is this period of volatile times. And that's very much what we see. Now, what we saw for the first 2 5-year periods is pretty much a good correlation between oil price and the level of exploration activity the following year. Clearly in those days, companies used to think, hey, we've made a bunch of money last year, we'll reinvest it in a proportion of that in exploration the following year. So good correlation then. But then what you can see really since 2020 is despite massive volatility in the oil price due to these different reasons, and also given what Tom said about the different outlooks for oil price prediction going forward in the medium term as well, what we've seen is activity levels have remained pretty constant. Now this is a chart showing high impact exploration wells. You see the same kind of lack of correlation if you look at things like lower 48 rig count, if you look at kind of deal flow in farm outs and M&A, if you look at kind of the non-high impact exploration as well. Now the way we interpret that is is companies retaining optionality in the face of this uncertainty about what the future may hold. So companies want to, if you look at the simple OPEC and IEA oil price scenarios, one is low and one is high, companies want to not overinvest too much now in the case that price collapses, demand goes down, and companies are left with stranded assets. At the same time, given an upside case in terms of high price and longer demand through the transition, companies want to be able to stay in the game and want to make sure they have got enough barrels in the ground to make sure they can be effective producers in that medium term for 2035 to 2040. So companies retaining optionality, steering a steady course through, independent of what's happening around the oil price on the back of that. We've seen the IOCs in particular have been very much focused on free cash flow. Cash flow has been going back into shareholder returns through share buybacks and return to investors rather than recycling it back into the upstream. And I think that again is pretty steady and it's steady as she goes in terms of upstream investment. And that really sets the frame for what we're going to see in terms of exploration activity going forward. So again, now look again, a bit bigger picture. What we've got here now, the hashed bars, again over the same 3-5 year periods, represent global production, total volume produced in those 3-5 year periods. And then what we've got in the solid bars are what we estimate to be global exploration, new barrels come to market through conventional exploration in those 3-5 year periods. And again, you can see back in the good old normal days, 2010 to 2014, we estimate that we brought about 33% of the barrels that have been produced to the market through new barrels through exploration. That declined down to 16% in the middle period and down to 10 or 11% in the last 5 years. So what we're seeing is, again, you can see now an increase in global production coming through and a decrease in the number of new barrels coming to market, which in many cases, that creates an opportunity for explorers to come through and think, well, the long-term trend is kind of upwards or flat. We're not producing as much as we want to. Maybe here's an opportunity for us to bring some new barrels to market through increasing our investment in exploration. So again, now thinking about what's been going on in terms of exploration activity over the last 5 years. Again, now what we've got now is year by year activity and performance rather than the 5-year look, just looking back at since 2020. And again, you can see the number of wells being drilled, pretty much steady as she goes. In terms of 2025 now, we're well into 3Q, coming towards the end of 3Q at the moment. We see similar numbers again. Again, despite what has been kind of a lower oil price for the last few months in particular, what we're seeing is the number of wells probably to be completed by the end of this year will be similar to what we saw at the end of last year. I think we've currently completed about 58 wells in our last count so far. We see another 28-ish in the planned or drilling status at the moment, of which a proportion of those will be completed by the end of the year, which takes us probably to around about the 75 to 80 number again. So no significant change in the amount of activity going into exploration. But on the right-hand side now, what you can see is the number of barrels being found, split by oil and gas, and then the solid lines there represent our success rates. How good are we at kind of finding commercial barrels or finding indeed technical barrels, which may be great technical results, but may not result in new barrels coming to the market. And again, what you can see through there is more or less a year-on-year decline in the number of barrels which are being found. We saw it over the last 15 years, with the aggregate volumes going down in each period, and now you can see it just about happening again. I think where we are at the moment, again in 2025 so far, is we've probably found I think we have about 3.5 billion so far through the year. So again, unless there's some big change happens in the next 3 or 4 months, we can expect similar numbers to maybe what we had last year. Again, perhaps a little bit lower. We'll wait and see. We're not quite at the end of the year just yet. So overall, we're seeing kind of activity levels being pretty steady, but the return on the investment in terms of exploration and new barrels coming to market has been on the long-term decline for the last 15 years, and strong indications of a year-on-year decline as well coming through. So real challenges there in what the exploration community do to find new barrels to come to market to fill that gap going forward. So again now, looking at the exploration landscape. So what we've got again now is looking at the number of companies involved in high-impact exploration wells on the left-hand chart through here. We saw we had 140 companies drilling wells in 2010, up to a peak of about 177 in 2013, and declining now to just about half of that in 2024. So again, the number of companies investing in exploration has gone down by about half. You can see the aggregate numbers there shown over the 3-5 year periods again. 354 companies in total, down to 235, again down to 178. So something is happening in the investment community. The investment in exploration is going down with fewer companies exploring all the way through. Now then, if you look at the middle chart in terms of who are the companies, what kind of companies are exploring, and again, the blue here represents the national oil companies, the NOCs. Split out by the dark blue represents the NOCs who are exploring internationally, i.e. there may be an NOC of a certain country, like Equinor, for instance, is the NOC for Norway, but does invest in exploration internationally. Petronas, the NOC for Malaysia, invests in international exploration as well. So the dark blue represents international exploration outside the home countries by the NOCs, and the light blue represents the investment by NOCs in their home countries. Then at the bottom there, and bottom of the stack, we have the green colour represents the super majors, and the large and mid caps shown in red and grey. Now, for the first time in 2024, we saw the majority of high impact exploration investment, 51%, was taken by NOCs. So the NOCs are taking a bigger slice of the pie for total investment in exploration globally, and at the cost of, you can see which group has been squeezed out. Well, it's probably going to be the, some shrinkage in the super majors, probably, but the biggest change has probably been on the smaller companies. So fewer smaller companies coming to market and really wanting to invest in exploration. And again, on the pie chart shown on the right-hand side in terms of discovered resource on the back of that, and again, the biggest volumes were being found by the NOCs over the period 2020-24, and indeed in 2024 in its own. When the largest discoveries seen in 2024 were in fact big discoveries offshore Kuwait and a couple of late entry big discoveries coming out of Russia as more activity started to become visible, if not happening in Russia since things changed in 2022. So the whole landscape is changing there with fewer, the NOCs and the super majors probably taking the lion's share of the investment in terms of international high impact exploration. What you can see now again in terms of the high impact wells being drilled, same thing, coloured up by company peer groups, the super majors in green, the NOC is covered in the two shades of blue, and the large and mid caps shown in red. And again, you can see that the majority of the companies investing are the super majors and the NOCs. A couple of the large caps there, Eni coming through. Eni has been a very strong investor and performer over recent years. Other companies towards the tail there, Hess now subsumed underneath Chevron. We've seen Lundin go away. We've seen Wintershall Dea go away as well. So the exploration company landscape, as we saw, has halved over the last 15 years, and indeed is reducing every year as more mergers and acquisitions take place and companies choose to move out of the industry or move out of exploration and perhaps focus on more on something different. And then the same thing now on the right-hand side shows the actual performance in terms of discovered volumes by the same company peer groups. CNOOC doing significantly well, a combination of obviously success in Guyana with the Exxon and Hess group in offshore Guyana, and also some big success coming from China in their domestic offshore exploration in China as well. After that, you see Eni coming through, again, disproportionate success for its investments and its size compared to the super majors and the NOCs. Eni strongly now regarded as probably the top explorer among the community at the moment, and the question I'm most asked these days is what makes Eni so good, and we can maybe talk about that over a coffee later on. After that, again, you're seeing the NOCs and the super majors really dominating the landscape, and again a big absence of the smaller companies coming through and really providing that kind of new blood of exploration ideas coming through to the market to really open up new kinds of possibilities. Okay, so what's limiting it? What's changing? Why are we not being as successful in terms of exploration as we have been in the past? And what does the industry need to maybe do about that? Now, there are a couple of quite complex charts here. What we've got on the right-hand slide is the timeline along the bottom, and then the vertical axis there represents how much volume has been found in different geological plays over the last 15 years. Now, the size of the bubble and the position on the y-axis represent the total volume that's been found on the back of a play opening discovery. For example, in offshore Suriname, Guyana, we had the Lisa discovery by the Exxon group in 2015. And since then, we estimate that whole play has found about 8 billion barrels of commercial liquids. A lot of gas has been found there then, but that's not being held as commercial. Challenges about kind of monetization for gas in a fairly remote part of the world. So that was a big success, really, up about 8 million BOE. Before that, you had the offshore East Africa gas discoveries there. Again, 15 billion BOE of gas being found back in about 2010. And before that, in 2006, was the off-the-scale numbers found in the Brazil pre-salt. But then, if you look at that, what's been happening, you see this cluster of new exploration opportunities being opened up, very much kind of, not many of them really above 3 or 4 million BOE. In fact, the average coming out is around about 1.5 billion, and the median for new opportunities, new plays being opened up, not just what's been found in that one exploration discovery well, but what's been found in all the follow-on wells on the back of that initial success, is really far smaller than it had been in the past, around about 500 million in median case and 1.5 billion in the mean case. So the opportunities are not really coming through there. Companies drill high risk, less than 10% chance of success for a big frontier exploration well, but they drill that not for the success they're going to find in that one well, but more what it might open up, what it might de-risk in terms of really understanding of the geology to go on and make some more successes on the back of that. But those opportunities just don't seem to be there. We're seeing more and more that companies are drilling some significant, interesting, exciting frontier exploration wells, but they're not opening up new opportunities. The plays seem to be quite limited in their sizes coming through. So companies now are having to dot around and have a more broad geographic portfolio, drill more high-risk wells in different geologies around the world, trying to find the kind of volumes that they might need to bring more barrels to market. So that's one of the challenges we face. The next one, again, linking into the challenges that Tom alluded to in terms of the supply chain, is seismic data. Now, seismic is very much in the supply chain for us, but really is the fundamental tool that we have as explorers to really understand the geology and look for new opportunities. We use seismic data in the initial scoping stage to really understand the whole geology of a margin. We use seismic data to mature the prospects, and we use seismic data to make sure we plan and operate the well safely. And what we can see again now is the amount of 3D seismic data that's been acquired has again halved over the last 15 years. So we're now acquiring less than 50% of the data that we acquired 15 years ago. That's put massive stress on the seismic industry. You're probably maybe aware of a number of consolidations taking place over the last 5 to 10 years, with only 2 or 3 companies now having active boats in the water, for instance, and a smaller number of companies all trying to collaborate together to try and take advantage of what is now a far more limited opportunity set for them. Again, because partly there are less companies exploring, less companies spending money on seismic, and therefore less seismic being acquired. Then on top of that, on the right-hand side, what we've got is the number of surveys that have been acquired over the last 10 years now. And so, for instance, in Norway, we have around about 60, 65 surveys have been acquired over the last 15 years. But here is how many of those surveys have actually been drilled. So we're seeing that only around about 40% of the surveys acquired in Norway have actually led on to being an exploration well being drilled on the back of them. Now, that's in some ways that's good news, because what it means is that the seismic data is really good at polarising the risk. Companies acquiring some seismic data, they're looking at it in detail, thinking, actually, there's nothing there. We thought there might be, but no, we're not going to drill a well. That's proven there's nothing there for us. Let's go and look somewhere else. But what that means, again, is that a massive amount of seismic data is not being squeezed as tightly as it could be, and there may be a lot of opportunity to be had by companies to go back and look at those undrilled surveys and think, is there something there which we've missed or maybe someone else has missed that can be taken advantage of in the future? So challenges in terms of the geology, which generally I think is starting to get a little bit more limited in terms of what we can find and what we can explore for, and challenges in terms of our ability to mature prospects, find new geology, and find the opportunity set in the prospect inventory to go through and provide us with drillable prospects. So what are we going to see? Well, I think for the IOCs, what that means is, again, with the idea of bringing new barrels to market, then we can see exploration will continue, but probably again at measured levels, given the uncertainty and volatility in future demand. We can probably expect more M&A activity to take place, more consolidation. Now, that's not going to bring new barrels to the market. That's very much about just moving them around within the current companies who are investing in that kind of opportunity. We can see probably more companies looking at what we call discovered resource opportunities, DROs, where there has been some kind of discovery made sometime in the past. It's been left in the ground for maybe technical reasons, maybe above ground challenges, maybe fiscal reasons, and maybe in many cases now we're seeing companies going back and looking at the shelf of opportunities which haven't been moving forward, thinking actually maybe we can make that one work. Some good examples might be what BP are doing in the Paleogene in the Gulf of Mexico, Gulf of America, and the Cascada and Tiber discoveries, which were discovered many years ago but have been sat on the ground, sat on the shelf because they were too complicated to develop. And also recently as well, we're seeing some companies, I think BP and Total again, Chevron, making access into discovered resource opportunities in the Middle East. Again, a lot of opportunity in the Middle East, much of which has not been invested in for recent times. Now the IOC is looking to bring new barrels to market in a challenging exploration environment, maybe going to look in other people's backyards for what they can do and help companies mature. And maybe again is unconventionals. Tom mentioned the European super majors, but look at the Americans who massively invest in unconventionals in the lower 48. Chevron and Exxon both produce around about 35% of their volumes from unconventionals through there. We can see some companies perhaps pivot into unconventionals. Challenges around that, the Permian really is challenged at $60, $65 a barrel. But some companies, I think Exxon probably the leader on this, looking for new unconventional opportunities in other parts of the world. And they're talking up, for instance, Algeria as being the next Permian basin for them. We'll see what happens on the back of that, but that's certainly something through there. So the key takeaways then, global volatility is leading to high impact explorers maintaining current activity levels in order to maintain optionality and create optionality in the future. The number of companies investing in exploration and the volumes being found has halved over the last 10 to 15 years. The landscape being increasingly dominated by the companies that can self-fund, the big NOCs and the big IOCs, with less money coming to the market from the investment community for the small caps who have been, in many cases, the creative explorers over the last 10 to 15 years. Opportunities to bring new barrels will go down due to reducing play sizes, less geology to be explored and less 3D being acquired. And whilst conventional exploration will continue, we do expect more activity in M&A, DROs and potentially unconventionals to bring those new barrels to market going forward. Okay. Questions, Gareth? Is that okay, Gareth? Yeah. Questions? Yeah, please, Alex. Yeah.
No, thanks for letting me jump straight on. Great presentation. Thank you. It was really, really insightful. I guess really nice to sort of see the three epochs you sort of laid out for the sector for the last 15 years. What role do you think the unconventionals have had in driving that, and in sort of flatlining to some extent the cycles that we've seen previously, because they've kind of got a ceiling, and then once they get, well, they've got a floor, and then once they get above that floor, they sort of kick in and sort of flatline everything, don't they? Is that going to continue? Has that run its course? Where's the Permian going?
Yeah, well, Exxon is the biggest player, both in terms of biggest IOC in exploration and the biggest producer in the lower 48 as well. And they have been, in fact, one of the biggest explorers. I think the challenge that Exxon faces is that, again, the Permian is challenged at current prices, and the biggest, and Exxon, in many ways, is a victim of its own success in Guyana. And so it's having to reinvest. Now, Guyana is what, 10 boats coming through at the moment, 4 or 5 online now. The challenge for Exxon is going to be, well, what do we do when Guyana comes off plateau, which is a great reservoir, it's going to come off plateau very quickly. They're going to lose that 8 billion barrels of reserves coming through, producing 1 million a day from the boats they're going to have coming through there, even 1 million now and more to come. So they're very much in the case of looking for the next Guyana. Now, unconventionals maybe offer that, but as we said, no, unconventionals are a long-term game, low rates, and fast declines. So they are very much looking for the next Guyana in terms of conventional exploration as well. We see Exxon taking very big positions in frontier basins around the world at high equity, very much thinking we want to find another 8-10 billion barrel play. That's what they're going to be doing. Chevron, another one, they've probably been underinvesting in exploration for the last few years, and they have been relying on the unconventionals in the lower 48. But now, again, they're seeing a turning point for them, and they are now upping their game in terms of taking on exploration acreage for conventional exploration. The Hess acquisition, again, is going to give them the same challenge as Exxon, where they, again, will now have to find more barrels to replace what's going to come off plateau very quickly in Guyana for them too. So I don't think the unconventional, spend on unconventional has taken dollars away from conventional exploration, basically. Yeah?
Two parts. First part, I don't have a feel for the time from concept to survey, survey to drilling, drilling to extraction, just as a general thing. And then the second part is that getting smaller, as in from initial decision to extraction, or is it getting longer because the decisions are getting spread out?
It's, so rule of thumb guidelines would be probably from license award to first survey is probably not very long, for the order of 0 to a year. If companies have bought some seismic before the license is awarded, that's kind of 0. And then typically from last shot and seismic to first well, it's around about 2 to 3 years typically. And then from discovery, and the first well may not be discovery, to FID, on average is around about 5 years still on average, but with a massive range around that. It can be as quick as 3 years in some cases, up to, we're seeing now, again, because companies are now looking at discoveries they made in the past, so in some cases a discovery 15 to 20 years ago is now coming to FID. but the average is around about 5 years. And then FID to first production, again, depends on the scale of the project, but again, another 5 years. So typically full life cycle is around about 10 years, is a good number to have in the back of your mind. So we are in a long-term game. And there was some discussion earlier about kind of, one of the challenges now is that the IOCs have now realized that they need to maintain this optionality. They need to stay in the game and find some new barrels, but that's a long-term game. Now, what we're hearing as well is that they're not being rewarded by the investors for that. The focus for the investment community over the last 5 years has been on short-term returns. Mm-hmm. And so that's great, you can do that. You can, if you're a big company with a big integrated portfolio, you can drill on near-field exploration and near-field production on the back of existing infrastructure, ILX as we call it, and that's great, but it doesn't fill the hopper with new barrels coming forward later on. So now I think what we're starting to see is we need to educate the investment community that they need to reward certainly the big companies to reward them for long-term investment and long-term exploration growth and adding the volume as well as the value coming through, which is why perhaps the landscape is changing to be the self-funding companies, the super majors and the NOCs who don't rely on third-party funding from the markets coming through. And that's something which I think we might see to change over the next couple of years. Was there a second question there?
No, it was just about whether they're getting smaller in timescale.
Oh, in terms of timescale? It depends which company you look at. I think, again, any highly regarded in terms of the best explorer and in terms of being the fastest to bring things to market as well. What they did on Zor and Blaine is kind of best in class coming through at the moment. There have been some challenges on the back of that. I think often the price you pay for rapidly bringing things online is you haven't appraised it properly and you might pay the price later on. We saw Zor has had some impairments on the back of probably under appraisal, more complex reservoirs and more complex fluids than they thought they had when they first took it to FID. But yeah, it's kind of there. I think one trend we're seeing is more use of recycled FPSOs coming through. I think in Namibia, one of the current hotspots now, we're just kind of discussing the kind of the sweepstake and who will be first to get to production in the Orange Basin in Namibia. And personally, my money would be on the JV with Eni in the Rhino JV with Azul, which has Eni as a partner in that. And they may well look for a repurposed FPSO there rather than the gold-plated new facility which Total would probably build, for instance. So yeah, it depends, but yes, there is movement there.
Thanks, Graham.
Thank you.
We're going to keep going. If they start bringing in food, don't worry. We'll either break early and do a bit of a working lunch, but one way or another we're going to get food and still get content in. So thank you.
Okay, thank you.
Okay, so I'll try and fire through this a little bit quicker. But yes, feel free to eat during my presentation, I don't mind. So yes, my name is Teresa Wilkie. I am the director for Rig Logic. So I'm very much specialized in the offshore rig side of things. So we track where they are, where they're going, who they're working for, who's looking for a rig, those types of things within Rig Logic. But today I'm going to wear a couple of different hats. So I'm going to be looking at the offshore energy services a little bit more broadly. So what we'll do is build on some of what Tom already spoke about and some of what Graham's spoken about on the exploration side too. But look at the sort of cost challenges that we're seeing and how some of the oil price fluctuations have impacted operator spending in terms of how that's impacting final investment decisions globally and trickling down into the different parts of the energy services, so offshore rigs, offshore supply vessels, and subsea tree orders or equipment orders. Okay, so just starting off by looking at some of the operators' E&P budgets from 2019 through to 2025, and that's we're taking into account in some of the other graph here on the right-hand side, some of the oil prices, industry costs, and then subsea tree awards as well, which is actually a good proxy for offshore rig demand, and then trickling down to the supply demand as well. So as you can see from that first chart there, most operators have now actually exceeded their 2019 spending levels, and that was following the pandemic-driven budget cuts. But investment strategies we see remain quite mixed. So you have some operators like Equinor and Chevron who have been scaling back in 2025, while others' investment strategies, while others have been actually increasing their spending year on year. So over the period, as you can see on the second chart there, there's 3 clear phases, which Tom kind of has already highlighted, and Graham as well. So 2019 to 2020, we saw the low oil prices, low costs, and the tight budgets, which led to around 217 subsea tree awards. Then from 21 to 23, we saw the oil prices rise faster than the costs and budgets, which gave operators more cash to invest. And then off the back of that, we saw tree awards increase to 257 per year. Now in 24 and 25, again, as we've already heard, oil prices are falling, but industry costs are very high. And this has squeezed operator cash flow and led to calls for 15 to 30% cost reductions from suppliers. Now the pressure is continuing to build, and as revenues decline, either operators will have to ease their capital discipline, or the supply chain are going to have to cut their pricing and to keep those projects moving. And with the latter, I think, being the more realistic outcome. So with all of that in mind, how is this impacting the final investment decisions for offshore projects? So for 2025, we've actually revised down our figures. So this is your 25 here, and you can see that initially in January, we had that projected 61 final investment decisions. But we've seen quite a few delays. And that is, of course, the high industry costs, project financing issues, and then, of course, your CapEx rationalization and the optimization efforts that we're seeing are ongoing. Now, the map on the right there, that highlights some of the major FIDs that have managed to go ahead this year, although it's not everything, so not exhaustive. Now, looking into 2026, though, it is a slightly more optimistic picture. So we're expecting 58 field final investment decisions. So that would be a 35% year-on-year increase. And again, that's driven by the expected supply chain cost reductions that we believe we'll see, but also on new gas developments and satellite projects in areas such as Norway and Asia Pacific. And so we expect to see operators focusing on utilizing more of their existing assets and areas where they can have quicker return on investment.
Can I ask a quick question?
Yes.
The reduction in FIDs and the increase in Q1 next year, is that an expectation of rollover, or is that cancelled projects?
It's a combination. So some that we expected to see this year will roll over into next year. So I'm trying to think of some off the top of my head. Graham, maybe you would have. Yeah. Well, there are a couple certainly in Africa and West Africa that we expected to see this year, and in the Mediterranean, I know, which we expect now to see in next year. But then we also saw projects that were supposed to reach FID in like 21, but they've had to go way back, look at all the project economics, and we'll see some of those come across into 2026 as well. No problem. Okay, so this is turning now to offshore rig activity. Oh, no, I went too far. So how is all those factors now trickling down into offshore rig spend and the actual drilling side of things then? So we split it out by the 3 different rig types. So your jackup demand, so your more shallow water units, and then the 2 floating rig sides, so your semi-subs and your drill ships. So semi-subs, for anyone who doesn't know, typically more used in harsh environment areas, so traditionally the North Sea, Canada, Australia, regions like that. Drill ships used pretty much anywhere else, but typically not in harsh environment areas. So for the jackup side of things, well, in fact, I think overall you can see a general trend for all of the rig types. So we saw an uptick from post-COVID, so 21 right through to 22, 23, and then falling off in demand. And that's for different reasons, actually. So on the jackup side, what we saw in 2024 was a change from Saudi Aramco, who, I would say, the Saudi government, which kind of changed some of its strategies in terms of oil production targets. And then we saw them cancelling 36 jack-up contracts. So those, not cancelling, suspending 36 jack-up contracts. So that created additional supply in the market. And we saw the Middle East sort of demand award activity fall quite rapidly during that period because they weren't extending contracts. We saw other operators in different regions holding off from tendering because they saw all this additional supply from the Saudi market that they could take in a little bit more cheaply as drilling contractors try to bid those into different markets and were taking lower day rates for those. And then we also saw a reduction in award activity also in Mexico, where Pemex, again, also suspending contracts due to their financing challenges as well. So we have seen a massive drop away in the jack-up segment because of that. And you can see that from this year, we've actually seen that reflected in day rates as well. For the semi-sub market, this is very much a regional story. So the dark blue line, so that actually indicates the dark blue segments indicates Northwest Europe. And we have seen, we saw again a sort of ramp up through the years where we saw sort of higher oil prices and lower costs. And then again, a drop away, a very significant drop away in 24 and quite a dull demand activity in 25 as well. And that is off the back of what we're seeing in the North Sea. So in Norway, we saw a lot of demand awarded the last 2 years. So not a huge amount of awards coming through this year or last year. But in the UK, very, very flat. Obviously, a lot of tax and regulatory challenges for operators. So we haven't seen a lot of awards coming out of there. And in the drillship market, a more positive one. So last year remained very high in terms of demand. That was very much driven by Brazil, Petrobras, the US Gulf. We saw a little bit of a decline in Africa, but we expect to see some really big tenders coming out of West Africa and East Africa over the next couple of months, where we expect to see more growth. A little bit of a slow year. As you can see, day rates are coming down, but we expect that's more of just a dip in demand. And this is more just the outlook for the rig market side of things. So you're looking at supply, demand, and utilization here with the supply in the back. So we have seen, we actually saw the supply of units really ramp up over the 21 to 23 period, 24 even in some cases, as we saw the demand grow. So, that called for more supply. But we've seen, as the market and utilization started to filter off, we've seen more attrition, so more units being scrapped, and not a lot of new builds coming into the market. In terms of demand for jackups, in fact, in terms of demand for all rig types this year, you can see much lower. So 89%, so falling from 93 to 89% for jackups, very much led by that lower demand coming from the Middle East. In the semi market, again, 78%. A lot of that is off the back of lower demand coming from those harsh environment areas, and especially in the UK, where we're just not seeing the levels of plug and abandonment and development or exploration that we have seen in the past. For drill ships, again, a dip there. That is off the back of a lot of those sort of cancelled or delayed FIDs that we had expected to see come through. And just those sort of campaigns being pushed into subsequent years. But it tells a more optimistic story that we do expect to see some increases over the next couple of years, as we expect to see those sort of costs come down in the supply chain, and hopefully some of those projects can move forward. I would say the recovery in the jack-up market, there is, of course, I would say sort of levels of recovery that we could say, different levels of recovery in terms of utilization, and that all depends on different scenarios of how things play out. Of course, Saudi Aramco is a major driver behind the jack-up side of things, so if we see them start to take in some of their suspended units, that will impact other areas of the world in terms of the supply and what's available. So utilization could increase faster, day rates could go back up. But this is, I think, how we expect to see it over the next couple of years. Now, how is that all impacting the sort of marine support side of things, so the assets that support the rigs? So as you can see here, so this table here is basically highlighting utilization within different regions this year for your platform supply vessels and your anchor handlers as well. So you can, the sort of peach color shows a balanced market, the green, a busy market, and then undersupplied with the dark green. And you can see that the GCC, so the Middle East, is a very, very undersupplied market. So this is an area where we've seen unprecedented growth in terms of EPCI award contracts, so Saudi, Qatar, and the UAE. And of course, we've seen a lot of rig supply growing and rig demand growing, and we've needed the assets to support them. However, you will see that from the second chart there that utilization in the green, so it's going from 75 to 72% this year. Some of that is off the back of the lower utilization that we're seeing in the rig market. So that's coming from the jackup and the floating rig side of things there. So I would say that the market will dip this year, similarly to the rig market, but we are expecting further recovery over the next few years and to remain very steady, and especially in areas such as the Middle East, Africa, and in South America as well. So a lot of the areas where we see the most activity with offshore rigs. And this is a chart I just wanted to add in to kind of emphasize a little bit of what Tom talked about at the end of his presentation. So in terms of the OSV fleet, which is a very, very large fleet, especially when you compare it with offshore rigs, we have seen a lot of attrition over the past few years, but we've kind of got to a point where we've reached enough of getting rid of those older assets. But we're not seeing as many new builds come in. So currently there's 175 new builds on order, with about 50% of those to be delivered in the next 18 to 24 months. Now, even with all those new builds, even if all of the new builds were to be delivered, over the coming years, we would still 27% of the OSV fleet would still be over 15 years old. So that's that existential threat that Tom was talking about earlier, in terms of not having the assets, not having the the assets that are new, lower emissions, or are, I suppose, capable of doing the work, or are being replaced by newer assets that won't have as much downtime. Oh. Oh. There we go. Okay, so just to finish off, I want to finish off with where we see the opportunities in terms of the supply chain and the offshore energy services sector. So this is basically looking at where we see the average daily production from 2024 versus 2029. So with the sort of heat map, but it's clear to see where the growth is near term for those sort of more near-term opportunities, and where the investment is going to come from. So again, the Middle East, we've heard it from Tom, myself, from Graham as well, in terms of some of the discoveries coming out of there. That we're going to see some major gas expansion projects coming out of areas like Qatar and the UAE. There's ongoing brownfield developments and investment going into Saudi Arabia. The Americas will remain strong as well, with Petrobras's pre-salt developments, first oil from Suriname, and growing production from FPSOs offshore Guyana as well. The US Gulf, it's seeing muted growth in terms of the shallow water, so some of the decline out there. But major projects like Whale, Kaskida, and Vito, they'll all help sort of offset some of that. And yes, of course, and then some of the infrastructure-led exploration as well will also support some of those fast-track developments we're seeing there too. But in contrast, you can see the UK up there. Not to finish off on a downer, but we are expected to see declines. And again, obviously, that comes back to those sort of regulatory challenges that we're seeing, while Norway, up there as well, is expected to remain flat, and that's supported by projects like Johan Sverdrup Phase 3, and then some smaller sort of satellite projects as well. So key takeaways, some which are very similar from the other guys' talks. Rising supply chain costs are impacting how many FIDs we're seeing coming out, dampening subsea equipment awards, rig and vessel demand. However, sentiment is definitely improving for next year, especially from the second half of next year. And again, that's supported by some of those expected cost reductions that we see in the supply chain, as well as some new gas projects and a more focus on quicker return on investment projects. Rig and vessel demand expected to rise, though again, the recovery does depend on certain players and what they decide to do. Some of those larger NOCs, likes of Saudi Aramco, Petrobras. So I guess that will obviously impact some of the projections that we have. There's a growing concern on the aging assets, whether that's the rigs and OSVs. And I guess some of the biggest opportunities that we're seeing, again, coming from those key areas like the Middle East, South America, and yeah, again, the UK remains a little bit of a challenge. So that's it from me. Thank you. Questions? Okay. Oh, there is a question. Yes.
Yeah, sorry,
yes, Keith.
You're seeing a lot of vessels coming in, specifically rigs, really old, sort of 30-year mark.
Yes.
They're obviously getting very expensive to maintain, but nobody's really building any in the rig market.
Mm-hmm.
Is that hesitancy associated with the market, with the 10-year outlook, or is it?
It's a combination of things. There's that, of course. There's all the sort of I think there's the worry about where demand is going to go, because we have seen fluctuations, but there is the cost inflation that we've seen. So a rig that would have cost maybe 600 million to build in 2013 now costs over $1 billion. The shipyards are very busy with other things, so a lot of the sort of offshore wind projects or other, so it's actually very difficult to get the right time. A lot of the new builds were actually ordered, some were ordered speculatively, but the shipyards gave really good terms, so you didn't actually have to give that much of a deposit. You could, that's why we saw a lot of assets being left stranded at shipyards, when we had the crash in 2014, because drillers saw that demand had kind of flopped out and that they could just leave the rigs in the shipyards. So I think the shipyards are a little bit hesitant as well to take on rig deliveries, because a lot of them still have a lot of the assets stranded, and they now own these assets. There's a lot of scar tissue from that last new build cycle. And we also still have quite a few new builds sitting at the yards which haven't been delivered. So I think there'll be more focus on taking delivery of those, finishing the construction, taking delivery of those, or upgrading current assets to make them more maybe energy efficient, or putting new technologies on them that can help with the drilling more efficiently, drilling quicker, things like that as well, rather than ordering new builds. Yeah. Okay.
Thank you. Okay. We are going to break for lunch sorts. So the toilets are right and left. Fill up the crates. We'll probably resit early, so a bit of work on lunch, but after then we've got double David and London like that, and then two parts as well from Yvonne. So we've got UK transition, offshore wind, UK energy outlook, and decommissioning. Thanks for this morning. All right, welcome back everybody. Thank you. Welcome to the second session. So first up, it's a pleasure to welcome Mark Wilson, OE UK, to join us to kick things off in the second session, followed by Yvonne, and then we'll take some questions at the end of that before David wraps up on the UK energy transition. Just a little bit about Mark first, before I hand over the mic. So Mark is the Health, Safety, Environment and Operations Director for Offshore Energy UK and supports HSE and operational arrangements for the UK's offshore assets. The first part of Mark's career was with the British Army as a mechanical engineer, where he worked through the ranks to retire as Major. The second part of his career has been working in the energy sector, clearly, where he held HSE and operational roles both on and offshore. And finally, Mark holds a voluntary role as trustee for the UK's oil and gas chaplaincy. Out of his work interests are road cycling, family time in the camper van, very jealous, and developing his skills and artistic abilities with watercolours. Okay, so we'll do some, just before we go, we'll set the canvas. Mark, thanks very much and welcome.
Oh, thank you. Thank you. Hopefully I'm coming through loud and clear. Just a second, I'm in the wrong. Do I have to press the button?
Let me do it for you. There you go.
There we go. So hopefully I'm coming through loud and clear. So thank you very much for the introduction. I'm very much looking forward to this afternoon, this after break session, and very much the focus on the UK. I'm going to make no apologies up front in terms of some of what you've heard in my brief 15 minutes. You'll have heard already, and it's important that we continue to reiterate and replay the message. I'm also going to talk today about the emotional aspects, and let Yvonne follow with more about the data and the logic. So again, you'll hear some of this before, but it's important because it's a key messages that we want to replay and ensure that the government understand where the opportunities are for the future. I am an optimist, and hence the reason some of it brings us down, but I want to bring us back up again with a positive message in all of that. And as you've heard this morning, these are important times for our sector. You can see from a global perspective that there are plenty of opportunities, and those opportunities can replay to the UK as well, and Yvonne will talk a lot about that as well. Now, as was mentioned at the start, I'm 25 years in the British Army, and there's a lot of pride associated with that, a lot of pride to being a veteran. I'm now in an energy industry, and I'm proud of that as well. I've been in this industry for 14 years, but I'm not quite ready just yet to be an energy veteran. And we've got to make sure that the pride that we have in this industry is loud and clear and is replayed out to those in and around us who don't know the industry, that this is a great industry to be part of, and a great industry that can deliver employment, economic value and energy security for this country. But to kick us off, if you heard this morning, despite previous projections, global energy supply and demand continue to grow. Last year, global energy demand grew by 2.2%, and this is significant for two reasons. This growth rate was above the average rate for the past decade, signalling a return to lower inflation and greater economic output. But we saw growth in all of the core energy sources. That's growth in oil, gas, coal, nuclear and renewables. So we want to make sure that we understand that this energy transition is about all forms of energy, and you'll hear people mention about it's an and, not an or. I'll come back to that later. But we want to recognise as well that sort of sometimes what people see as an over-focus on oil and gas is not. It's not about undermining renewables. We heard there this morning about the great opportunity in wind, and we've got to make sure that we recognise that growth and that acceleration of renewables deployment to assist with the energy transition, and recognise that we all need all energy forms in there as well. And the UK, of course, has got a great energy mix. We've got a fantastic opportunity as a country, being an island, from not just an oil and gas perspective, but from maximising the resources around us, the areas around us, such as the sea. We have recognised, though, that there has been a decline in energy production. In 2024, we imported almost 24%. We imported almost 44% of energy into the UK. So imported almost 44% of energy in the UK. And the government's plans, if you read the Building the North Sea Energy Future, is that reliance on LNG for the next 5 years will increase as we move to renewables. So we've just got to be conscious of that with what we're doing, that there is this thought process of the UK having an inability, of course, to produce enough energy that will change. But we've got to recognise that there's a fantastic opportunity from domestically producing oil and gas, wind, moving into hydrogen, of course, as well. But unless we take significant action, we're going to find that our reliance on energy imports is going to grow. And it's, we have to recognise it's not the first time that the UK has faced challenges. Well, I'm sure there's many engineers in here today, many problem solvers. We are an industry of problem solvers, there's no doubt about it. And we've got a long history of dealing with energy transitions. Think about coal and how we dealt with that. We've got a long history of dealing with climate leadership. We do climate leadership pretty much every day in this industry, and we've demonstrated that when you look at things like the North Sea Transition Deal, where we've achieved a 34% reduction in greenhouse gas emissions since 2018. Something to be proud of, but not complacent about. More action to do, of course. But yeah, reflecting back, let's get a bit sort of looking backwards. You know, we were the first nation to industrialise in the 18th century. We developed the steam turbine in the 19th, and we pioneered offshore oil and gas in the 20th. Yeah, and now we're laying the foundation, as you saw there, to the largest offshore wind farm in the world in the 21st century, maximising, as I say, that water around us. But we should recognise that the UK's oil and gas industry is still a strategic national asset. Recognise that we've been delivering for over 50 years. That recognising as well that we support thousands of jobs. The offshore energy industry supports over 150,000 direct and indirect jobs amongst the communities of this country as well. And those jobs, that economy value add, contributes to the industrial capability as well. So the North Sea, as I said, is a breeding ground for innovation, for technology development, and we've achieved feats that in the past have seen actually impossible to do. And we continue to do that day in, day out. Many people, when you talk about oil and gas, do not understand that there's 9,000 people plus working offshore right now. The 100 of assets that we've got, the thousands of kilometres of pipeline that we've got day in, day out. And it's our job to educate and raise awareness, just the importance of that infrastructure. I'm going tomorrow to Bacton to meet with some members of Parliament to reiterate the importance of the infrastructure on and offshore and how critical and interdependent it is to each other. And we've got all a role to do in playing that message back in a simplified way. So we recognise that we've powered the UK since the 1970s, and we can continue to power the UK for a large number of years, and we should be proud of that fact, as I say. But we've got to recognise that we need to nurture this industry. That nurture involves areas that you've heard about so far this morning, and a number of areas that will be covered by Yvonne and the team later on this morning. But we recognise that policymakers, governments, politicians, they have the opportunity and that responsibility to support the sector, to unlock investment, ensure the North Sea continues to power our country, deliver those skilled jobs that we talked about, and strengthen our economic security. So today, our integrated offshore energy sector spans oil, gas, wind, hydrogen and carbon storage, and it's ready to deliver that homegrown energy future. It's one that is secure, it's one that can be seen to be affordable, and one that can be lower carbon as well. But as I've said, it's not just about the or, it's about the and I don't know if you saw Dave Whitehouse, my boss at Offshore Europe. If you've not had a look to LinkedIn, he wore a black t-shirt with white writing on. It's as clear as it is black and white, and there it was oil and gas and wind and storage and hydrogen, recognising it's an energy mix, it's an energy transition, it's not an and. And wave, of course, yeah, we can bring in wave and tidal as well. Offshore energy don't look at wave, but yeah, wave and tidal. But that's it, it's about innovation, it's about technology, it's about bringing integrated energy in there as well. So thank you for that prompt in there as well. Happy with that one. So we're in a really critical and important time. You'll have heard that a lot in 2024 and heard it in 2025 as well. But we've got an autumn budget coming up at the end of November. We've got 10 weeks until that budget. And the government then will make choices that will shape the future of this North Sea. We hope to see some announcements. These decisions will impact the economic future of the country and be felt by communities, not just here in the North East, but countries across the UK. So we've got to recognise that where there is, in a world where we'll continue to use energy of all forms, even under net zero scenarios, it's basically paramount that we'll be able to meet our own demand where we can through our domestic production and maximise that. And I know Yvonne's going to sort of major on that when she comes to her presentation. But we need to have that immediate action to reinvigorate the UK's offshore energy system. Fiscal and regulatory barriers to investment in oil and gas need addressing. We mentioned that about EPL, and you can only this morning if you look at Energy Voice, there's some more pieces there about EPL, where we're seeing projects due to fiscal instability and increasingly tight regulations are not moving forward. They're not seeing that financial backing that will guarantee them moving forward into that development phase, and it's slowing the offshore energy advancement. We've got a great opportunity there. We're seeing a constant downplaying of production projections. So, and some of these you can see that published by the NSDA, they've been consistently being downgraded year on year. But what we're finding, the geology is not changing. The policy is changing. So we've got to ensure that we look at the opportunities, and we have got the opportunities. Our data shows us that it's in the region of 7.5 billion BOE that we can extract if we get the conditions right, and more of that to come shortly. So to rebuild the production projections of the basin, we would like to see, now we don't necessarily need to see this in 10 weeks' time, but we'd like to see some signs that we're moving in this direction, that we've seen a stable and globally competitive fiscal policy linking to EPL and those other areas, that we're seeing incentives to invest, a clear long-term commitment to ongoing licensing to maximise the acreage that we've got, to maximise the infrastructure we've got, faster approvals for new developments and licence award, and that pragmatic, proportional and achievable net zero regulations. So recognising, maximising economic recovery whilst also contributing positively towards net zero. So a warning though, that without urgent action, we may drift towards decline, that we rely more on imported gas, shipped and piped from overseas. It will send the signals that the UK does not wish to prioritise domestic production. But let's be clear, if that happens, it's a choice. The success and demise of our industry can happen by design or default, but either way, it is the product of choices. And to be clear, as we build up to that autumn budget, over the coming weeks and months, choices will be made that could accelerate the decline of our North Sea and gas and impede the growth of our North Sea renewables. Positively though, changes could be made that flip that around and flip that narrative, and we fill that middle ground where we're seeing a reform of the EPL, we're seeing some form of licensing that's moving forward. We recognise though that in times of volatility, having a plan is important, and the UK and the OEUK are proposing this homegrown energy plan where we recognise a clear path forward that looks at policy certainty, an integrated strategy, people and skills and supply chain strengths. So recognising that policy certainty is around the EPL and seeing reform to that with a predictable price mechanism. We see accelerating licensing, permitting and consent, and we ensure allocation round 7 is a success, giving investors clarity and communities the confidence they need. The integrated strategy treats energy as one system across all those vectors we've mentioned, looks at technologies that can start to deliver energy across the wide range, and including wave in there as well, and reflect back on that one as well. And so, as I say, it's not an either or an or, it's a both and an and. So, the vision for 2027, conscious of time, the positive bit. So imagine in 2 years' time, 2027, we're gathered here today. The UK has acted on a plan, confidence has returned, projects are underway, jobs are growing, graduates are choosing offshore energy, and hubs like Humber, Grangemouth, Teesside, Aberdeen and others are thriving. And events like today are no longer debating whether we produce oil and gas, but how we maximise UK value across renewables, decommissioning, carbon storage and climate leadership. The choices made this year will decide which path we take, there's no doubt about it. So really important period of time coming up, and Yvonne will give the data that links into there. Very quickly, there is an ask within all of this. There's something you can do. You can Google and go online and type in OEUK building the future North Sea. And there's a template there that you can take and write to your own MP. Now, unfortunately, Stephen Flynn and Andrew Bowie have been getting a lot of letters recently. However, you can write to your own MP to outline the importance of energy for this country, outline the importance of energy security, outline the importance of local employment, skills, the next generation, and the value that we bring through adding barrels to the UK's energy security and adding that back into the UK economy. So you can do that just by going on, and the template's there, you just put your name in it and likes of that, and I know some have already done it, but just to re-encourage you there as well. But the positivity, we're picking up, and I've had a few conversations, we're seeing the conversation slightly shifting with media, with some politicians as well, and we can all play our part doing that. I'm going to stop there, just get into the 30 seconds, and allow Yvonne now to sort of bring less of the emotion and more of the logic and the reason in there. But thank you very much for your time.
Hello. Right. Funnily enough, you mentioned Stephen Flynn. He arrived on my doorstep for a cold call on Monday lunchtime. My husband answered it. He's like, Yvonne, can you come to the front door? And I'm like, yeah, okay, what's happening? And he went, talk oil and gas. I went, oh my gosh. Well, half an hour later, I don't know whether his ears were bleeding or he went away kind of thinking, okay, I know a little bit more. But I've only got 15 minutes, so I'll be quiet now. Yeah, I'm going to try and put some of the data behind what Mark has mentioned. Tried to cut down on the slides. I've only got 20 minutes. Whoa! I thought I only had 15. Going to fire through it all very quickly, or fairly quickly, I hope. Anything you want to discuss in more detail, the teams here, Ali, Glenn, Matthew, they work in the Atlas team. We provide coverage of Northwest Europe in depth, UK and Norway. If not, I'll leave some cards out the front, and feel free to drop me an email and we can meet for coffee, or I'll pop into your offices and we can have a chat and do a mini presentation if there's anything of interest in this presentation. It's a busy slide, but tax is so key to where we are at the moment that I just couldn't ignore it. Figures are from the Office of Business Responsibility, and I'm not going to explain all the lines. It's complicated, it's complex, because that's the story. We all have been around the oil industry long enough that we know what's happened over the years, the cycles, the price volatilities, the battles to, get investment and keep it going. Does the marker work? No, I'll just have to stretch again. What's important? Oil price up and down, headline tax rate, up, down, up, down. Incentives in this period, lots of investment, driven by incentives, driven by high oil price. Yes, the sector's been in decline since 99, 2000. Production went flat. Something they often forget to tell us, but it did. It's not always going to be flat. But we re-entered a period of decline. Oil in 2021, gas in 2022. We've faced some hardships. I'm not going to spend time going over it. The forecast of where that oil forecast is going to go probably is down, but we've got two options. We've got a managed decline scenario, or we have an unmanaged decline scenario. I've just coined it in that phrase, but I think it really tells us the story of what we should be at. At the moment, I've never seen the sector have so little investment and everything on pause, and I think we all around the room can recognise that. We're waiting to hear how things go, but we are in that critical period because we have an ageing infrastructure, we have decommissioning costs that this line here increasing. Tax revenue from oil and gas, that will be revised down further based on the most recent NSTA forecast, and corporate acquisitions, etc., that impact that. Key points. 2016-2017, HMRC was cash flow negative because of decommissioning liabilities. Some point in the 2030s, early, probably, could be early 2030s, could be mid 2030s. It could go into cash flow negative long term, permanently, because of decommissioning liabilities. So decommissioning is so important. We want to have a managed decline because we want to have a managed decommissioning outlook and expenditure structure. And that has to be key for the UK as a whole. We're on the precipice for all of those reasons. We all know them. So as Mark said, production forecasts are what drives the Office of Business Responsibility figures. Those figures then feed into the government policy and the government outlook. So when they make the comments of, oh, it's in decline, oh, there's no opportunities in the geology, it's based on numbers, but the numbers are driven decline. And Mark has mentioned this and the Maximising Economic Recovery strategy of 2019. And we probably realistically need a government support that reintroduces that strategy, that reintroduces that target. Because if you've ever sat in an oil company and had to produce a production forecast, you find that your manager sticks 15 or 20% on it because they give you a stretch target. And we all think, oh, great, we'll never achieve that. But we maybe not achieve it completely, but we get there. So you need a goal and you need to get after it. On the left, the far left, we've got our chart, which just, as you probably have seen before, if you've seen us discussing, it's the economic cut-offs for the fields when they stop being economic and disappearing from the map. In 2019, there were 66 hubs, processing hubs, platforms. 2025, we've got 66. 43 is the number in 2030, based on our current investment plan and outlook into that. And it could be down as low as 20 in 2035. Now, you may say, well, if we've got 20 hubs and we get all of those tiebacks to those 20 hubs, then they're in the right place. That'll still work for the UK outlook. Probably not. Because our pipeline system and our terminals and the way that our infrastructure has been set up has been for much higher production throughput rates, and it's very, very intertwined, and it's reliant on the different hubs which have gas export to one route, oil export to another route, or liquids export to another route. The terminals, as Mark mentioned, they stretch from Shetland, Orkney, St Fergus, Teesside, Dimlington, Bacton, Barrow, still in operation. Jobs and services and local economy, all reliant on those services around the place. The map, very cleverly put together by my colleague Matthew, is a very simplistic overview, a tube map of the infrastructure. There you are, Matthew. And it's really just to show the connectivity of it. So we have, west of Shetland, Schiehallion, Clare, gas goes to the Sullom Voe terminal in Shetland, where it gets sweetened, rightly or wrongly, but then heads all the way up north to Magnus. Then it enters the flag system and it comes back through into the Shell terminal at St Fergus. And there's a similar story for many, many of these infrastructures. And if we look at the top 10 producing hubs, we can actually see that interconnectivity in a little bit more detail. On the left is the liquid export routes, on the right the gas export routes. And here you can see, from a liquids perspective, it looks pretty simple. 5 of the hubs export into the Forties pipeline system. But how critical is that five of our top producing hubs are in one pipeline system, but 3 hubs really influence sort of over 50% of that throughput rate. And if you look at that then, the gas export from these hubs, they're all going to different gas export routes. So again, it just underlies that interconnectivity between all of these different pipeline systems. So as these hubs are becoming uneconomic, each one, it's a house of cards effect, a domino effect. There's the viable risk now that not investing could bring down a pipeline route. And we saw it back in 2018 when Conoco shut the TGPP terminal, not the Conoco terminal, and it brought the whole Murdoch system, Viking system down. We've seen it before, we don't need it again. And hence why unmanaged decline, little investment, things ceasing far too early, it's a real risk and a real challenge. But as Mark said, we do have upside. We produced a report looking at, we've got an excellent prospectivity and discovery database. We looked at the prospects, Ali and the team, to pull that through and looked at what's still in the geology, because just because people aren't investing doesn't mean the opportunities are not there. There's 26.5 billion barrels of oil equivalent of resources and reserves and potential prospectivity that could ultimately be recovered. High percentages are in unlicensed. 38% of the technical discoveries lie within 25 kilometres of a hub, 68% of the prospectivity lie within 25 kilometres of a hub. Technology means that we could actually go a bit further, so the numbers are higher, 50 kilometres from the hub. But why is licensing important? Well, licensing allows companies to actually, get these opportunities and work up these opportunities and progress them through. And those companies can be small, pre-development, exploration-focused companies right through to the majors. And we see that. And it's a real case of getting them in the right hands. But from another point of view, it's demonstrating that the UK is open for business. It's sending that message out. We're open to business. We're open for investment. Can't stop much on the exploration stats. Again, we'd be happy to go into these in a little bit more detail. Just looking at a comparison of the UK and Norway, what we're showing is activity of the basin and the commercial success and technical success rates. Exploration, the last couple of years in the UK, the lowest it's been, Ali. But look, in 2024, we've got 100% success rate, so it must be great. I wish we could keep it going, but that's more a factor of doing the little that we did very well. But we have had successes, and particularly worth noting is in 2023, Pensacola, which was maybe not a frontier opener, but it was a play opener in that southern North Sea sector for dry gas opportunities. And the southern North Sea, as you can see from the heat map here, the southern North Sea hasn't been overly explored, and that's because, in part, over the last decade, that is. So these are wells in the last decade, and it's not been because for the first part of the decade, the gas price was very low. Second part of the decade, the second 5 years in the decade, the gas prices increased. So we've seen more coming through. So we've had successes, Pensacola, Abbey and Baker, which are great opportunities to get dry gas. It's what the environmentalists want. West of Shetland, underexplored, still huge potential. Another 1 or 2 discoveries out in that sort of northern gas hub could unlock the resources in that area. That's right, isn't it? So there's still opportunities, and we should still be going after it. Overall, success rates 29% in the UK, 30% in Norway. So overall, we can still do this well. Of course we can. Again, just looking at that upside potential. Won't dwell on it too much. These are the technical discoveries, maybe not classed as commercial, but could be unlocked with a little bit of a technical or commercial changes. Prospectivity heat map. With the hubs around it, and again, similar things. Takeaway, huge potential, still out there. Other point from this slide is that we have opportunities. There are 15 drill-ready prospects or appraisal wells that are just waiting to go, but they keep getting moved out because of the uncertainty that we're facing in the basin. And the licensing regime that we have at the moment, there are 3 firm commitment wells and 6 additional wells that could be drilled when they go through to Phase C decisions. The opportunities are there. The investment sentiment needs to be right to get that. And that can only happen from the right political support. That's what's in the ground. How much could actually realistically be exploited? So on the left is the low case, which is very similar to the base case, the current case, just maybe taking away, stripping out some of the near-term developments that we have, maybe taking down some of the assuming that Penguins doesn't perform quite as well or produce quite as well. The high case, looking at what could be recovered, the layers, the marginal gains, the well on Elgin, the continued drilling on Scott, which is an old asset. It's the marginal gains philosophy. So we've got 66 hubs, 143 fields out there. 1 or 2 wells just builds up that picture to give slivers that can actually increase that outlook. And that can move from a very unmanaged decline with fields and hubs ceasing quickly to a managed decline in an overall perspective. It is so important. And again, the marginal, the high case, that was built on a little bit of realism. So that's looking at the number of tiebacks in the last 10 years, the number of wells that have been drilled in the last 10 years. So it was really founded on kind of a conservative, realistic approach, and that would have recovered that sliver, 4.3 billion barrels of oil equivalent. But if you had deeper pockets for investment, you could get 7.5. You could achieve 7.5. And people say, well, is that possible? But back in 2013, 14.8 billion pounds, not dollars, pounds was spent, on capital expenditure. That was the number. And in 2014, no, sorry, it was 14.4 and 2014 was 14.8, or could be the other way around, but you get the drift. The numbers are huge, so if the pockets are deep enough, the opportunities are there. So it brings us on to decommissioning, and again, many of you will have seen a lot of the information here. On the left is our decommissioning outlook in terms of what's coming through for the different regions. Yeah, it's a huge amount of money. It's over $40 billion of expenditure could be spent. That number is going up all the time because we're learning, we're doing more. We've probably done the easy decommissioning for the older assets. We've done the easy stuff first, and the more challenging exploration wells are still to be decommissioned, for example. On the right, we're looking at the number of wells, because wells accounts for 50% of the spend. And you can see it's a very disorderly outlook, because these are when the fields cease, the wells become inactive. So 2029, we've got Beryl, we've got Forties, huge number of wellbores associated with that. Appreciate that some of that decommissioning is going to be getting completed in the next sort of 4 years before the fields actually stop producing. Very quickly, the backlog. And I don't mean that in the backlog in a rig sense, I mean the backlog in a we've not done it yet. Platform wells on the top right-hand corner, companies are generally pretty good at decommissioning the platform wells because they have disembarkation targets. Subsea wells in the bottom left-hand chart here, looking at the outstanding wells that still have to be abandoned, that we haven't done yet to date. It's over sort of 200 wells that, in the plugged or shut-in state, well over 200. Goes up to over 300, 400 as we go through. In terms of how many years' work that is, the chart on the right is just looking at that in terms of years. So we've got 25 years worth of work for the subsea wells that where the field ceased before 2024. So we know we're sitting on the clock of more than 2 years shut in, and 17 years for the wells where the clock started ticking for the guidelines for abandonment. Huge amount of work. But as you know, everybody in this room knows, they haven't been executing well abandonment terribly effectively, and it doesn't look like things have changed a lot for the rig suppliers there, or the well services and well companies here. Big white gaps on the contract outlook for the UK. By comparison, Norway, they've got a lot of developments coming on, and a few years ago they recognised they had gaps in their market, gaps in the supply chain, contract chain and fleet market, and they did something about it. They recognised that rigs were leaving, and they set in place contracts that were taking them out to 2029, etc. Impact of not doing decommissioning effectively. Well, dependent on the decline outlook, this is a scenario, slightly different scenario, but we just put it up here just to show that what can happen. So an unmanaged scenario and a managed scenario, high oil price, low oil price. We have flexed the COPs. So these are the economic COPs for the different fields when those wells become inactive. 2029, 700 wells potential. I'm not saying that is necessarily going to happen, but that's what can happen if the investment isn't right, the economics aren't right. We have an unmanaged decline scenario. We're looking at bringing forward all the requirements for well abandonment. If we've got too much too soon, we've only got a finite supply chain, a rig stock that is going down as rigs are looking for contracts elsewhere in the world. What does that mean? Well, if we don't execute in a timely manner, it's going to impact the costs, and the costs impact the decommissioning liabilities, and therefore we use the NSTA data, looking at the low, medium, high case cost scenarios that they present in their benchmarking reports with the number of wells, and you can see the difference. We're looking at 10 billion between additional costs between the P50 and the P75 case. Skip over that because we kind of know it all. So what does it mean? Well, again, mentioned back 2016, 2017 when HMRC went into a cash negative position because of decommissioning liabilities. That we have to bear in mind because we're all taxpayers in the room. The purple lines are showing the unmanaged scenario. So if we do allow the decline, and we do decline too quickly, we've got decommissioning activities that are coming at us. far too soon, and the risk of too much too soon. So we've got the risk of trying to execute all activity in a timely manner, too much demand on the supply chain, rig rates going up, costs going up. You know, we've seen the cycles before. And the HMRC has the potential to, well, it's not HMRC. HMRC could have, the payback is anywhere from 0 to 75%, depending on the tax histories of these fields. And so the E&P companies will be receiving this money back from HMRC. So it's in all of our interests as taxpayers to have an outlook that doesn't just maintain the jobs, the infrastructure, the service sector, the supply chain, everything that goes with maximising economic recovery from our existing basin, to the impact of what that means sort of mid-2030s when we don't have that, we haven't got necessarily the renewable sector built up to such a position that it could actually support where we're going to be. And I've run out of time, so I'd be very glad to hear I can't use my wonderful analogy, unless I've got 1 minute. Oh, please, 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 can I just do this really quickly? Co-pilot. It's like, what is oil and gas in its part of the energy transition? It came back as a championship, I'll say Premier League football team. So we've got oil and gas is the veteran striker, wind is the agile winger, hydrogen is the versatile midfielder, and David will come on and speak about these, and carbon storage is the rock solid defender. And the manager's strategy is, you're like the tactical brain behind the scenes, ensuring each player is fit, positioned correctly, and working towards the same goal, net zero. You don't bench oil and gas overnight, but you build a squad that can win today and tomorrow. And I really like that, so that's why I shared it.
As we had in previous sessions, please do ask questions, right? So again, this is for you guys. So we obviously try and fit in a few topics in a short period of time, but we probably can't answer all those topics in that time. As Gareth said, I'm going to go and start off on global offshore wind. So big topic, but I'll try and cover the sort of the broader sense of the market. And then I'll dive into the UK, where I'll talk a bit about offshore wind, but I'll also talk about CCS and hydrogen as well. So these, we have an energy transition team that works across all the different teams, but we have a few specific technologies that we have dedicated teams to as well, and that includes offshore wind, which I think if we go look back at our first work in that was back in 2014 or so. So we've done a lot of work in this for a long time, but it took us a while to, I think Gareth's just closing the, no worries. I'm not sure that was a please hurry up kind of but. So anyway, so I will cover with that. So I've talked to a number of you already in offshore wind, so I won't ask the same question and embarrass you. Who else is in offshore wind here? But it's good to see there are some dedicated offshore wind people here, as well as people who are maybe looking at this. And of course, offshore wind is important in this space because from an offshore perspective, as Tom's slide showed very early on, we're expecting 68% of EPCI spend to be in the offshore wind sector. So even if you're not in offshore wind, why aren't you? There's opportunity there, there's a lot of money being spent. But also it influences and overlaps with all the other activity that's happening offshore. And whether you're in a port or you're a vessel or any of those sorts of activities, you need to understand the interlinkage between those worlds because there's a lot of happening that is essentially impacting offshore wind, but also the oil and gas sector. And offshore wind, if you're not in it, again, it has a very different dynamic that influences how it evolves and develops than what I would call the traditional energy side of things. Now, unfortunately, if you are in this space, you're coming across a lot of headlines that are pretty negative right now. Whether you've been following the rise and fall, essentially, of an Ørsted with massive write-downs and trying to get any projects now move forward in the US is particularly difficult, isn't being helped by Trump being there, of course. But that's not a good sort of poster child, unfortunately, for the industry. Auctions are flopping. People are placing bets in different markets in different ways than they were before, and it's not very clear often to an outsider to understand why that might be the case. And it just creates a very bad impression for the industry. So that the headline essentially isn't always very good. The question though is why is that happening? Right, so essentially, if you look at this industry, it's a very young industry, right? It's no more than a decade or two old, really. And it's the first time it's really come across problems. It's the first time it's come across a large scale of volatility that's impacting essentially the structures and the mechanisms that have been in place to get it to the place it has now. And so while those structures played well to get it to this scale it is today, to get to the next phase of growth means things need to change. And it's essentially that phase of change that we're going through now. And the problem, though, of course, is that it has resulted in a downgrading of expectations of what's going to happen in the industry in the nearer to short term. So back in 2023, so this is prior to what we call the cost inflation period, which really kicked off the problem sort of cycle in this industry. We were predicting around sort of 350 or so gigawatts online by 2030. We're now much closer to the 2040 mark by 2030. So that's a 30% drop globally of what we expect to be in the water by 2030. That's a big drop. It has impacts in many different ways, but it has an impact in particular on what governments were hoping to do with this technology, right? So offshore wind to many governments was gigawatt scale opportunity, investment, billions of dollars being spent, local jobs, et cetera, right? And many governments aimed high, but essentially our view in terms of the likelihood of reaching targets, which is essentially our forecast for the sector, and the targets that they're then set, every single country is going to go and miss its 2030 target. That's not a nice story, right? That doesn't tell you a very positive picture. That is the case for more mature countries, so like the UK and Germany, for example. It's the case for the birthplace of the modern, call it offshore wind industry, Denmark. And it's also the case for all the kind of newer players out there as well. The slight difference we have, by the way, for the US is we've just essentially assumed it's not going to hit any target. So we've just given it 0% chance. That is a slight difference. There is a bit of offshore wind there, but we've just said, look, no chance whatsoever. Happy to discuss a bit more about that, but that's the slight outlier here. But everything else is essentially based on our projections of what we're hearing in the market. But if you come back to the left-hand chart again, you still have a market that from today up to here is growing at a CAGR of 20%, right? So not many industries are growing at 20% a year. You're not going to have 155% growth by the end of the decade. So yes, it is negative. It's going through a recalibration, a change in terms of what's happening. But there aren't many positive stories that are growing 20% out there in the energy sector in this particular way. So slight maybe mindset shift that people need to take, especially in the industry, and you're having to feel like you have to defend yourself. There's not too much to defend, actually, if you think about a growth story that you're trying to explain. The challenge is, where's the growth going to come from, et cetera, et cetera. And it also helps, just very briefly, to recalibrate your mind to sort of remind yourself where we were just 10 years ago, where the industry had 12 gigawatts in the water, and now we have 87, right? So massive step up. We were sanctioning 4 gigawatts. I think that was pretty good at the time. We're now in the 20s on a regular basis. This is year to date, so we haven't finished yet, but we're expecting something slightly lower than 20, to be fair. But people are still pressing the FID button, the final investment decision button. And they're leasing capacity, which is ridiculous. It's almost the same size as the market in that sense, as being leased again. That was slightly skewed because of Australia and places like that. But there's massive, massive leasing happening, which means people are still continuing to essentially get acreage, get positions, take FIDs where they can, and continue to grow and add new, continue to build. Yeah. 2025 is, by the way, quite a quiet year in offshore wind overall. And I'll show you some charts later to show you what that means. But this is not an industry that's standing still. It's moving forward. But if your mantra is, okay, we've gone through some really difficult times, we need to start to think a bit more carefully about what we're doing and how we're doing it, we're going to get into the conversations around things like value over volume, etc. Call it whatever you want to do. But people are recalibrating their portfolios to be more risk averse, essentially, and focusing on delivery, which is why we're seeing volume continuing to grow. Problem is, if you are lower risk, you're going to start to remove things from your portfolio that are essentially riskier, simplistically. And we do an annual survey for floating wind because it's a sector that's changed so much really over the last 3, 4, 5 years. It was seen as the sort of the future hope of the industry, and I'm sure it will be at one day. But in that survey, we ask, we do this through with Wind Europe, Norwegian Offshore Wind, Oceanic Network. We work through the main organisations who sort of focus on the floating wind sector to get a true sort of litmus test from the industry. Both the developer and the supply chain in particular, 2/3 of those are less optimistic than they were even last year, which was a pretty difficult year in this sector. And that's with all the wonders sort of like Green Volt getting, you know, an exciting sort of milestone, new areas being leased out, subsidies being more firmed up, etc. Actually, people are being less optimistic. And that's because of the state of the industry as a whole and the fact that floating wind is just a much riskier technology to deliver at this stage. And so that's been downgraded. And the second part of it is really how much you expect by 2030 and by 2040. So 2030 is this colour, 2040 this colour. Essentially, pretty much everyone, 2/3 majority, etc., you know, doesn't expect more than 3 gigawatts in the water. You go back about 2 years, people were expecting 15 gigawatts in the water. Big change. Yeah? And then going forward, and this includes China, by the way, just for clarity, which impacts things as well. Although that isn't the main market, just for clarity. But then going forward, the sort of comfort around where the market's going to sit, how many gigawatts are truly going to be in the water in 15 years' time is such a broad spread that, again, you know, who wants to invest in a market which has such a wide range of uncertainty? Well, it comes down to having the right strategy, the right focus, and then essentially, you know, picking projects that you think are actually going to be deliverable in that sense. But while the industry is recalibrating, it's resetting itself, it's sort of pulling back, focusing on delivery, ensuring value over volume, etc., the industry doesn't stop moving either in terms of innovation and evolution. So I just put up a couple of charts here. There are so many different ways of showing this, but I thought I'd use the example of turbine sizes, classic discussion point in the industry around what's been happening. And over the last sort of decade, 10, 15 years or so, the average turbine size, so you can see the kind of weighted average size of the installed turbine by order year, etc., has increased over time. And the different colour bubbles show you where that's happened, essentially. In the UK, I don't think the pointer works, but the UK essentially is actually installing, on average, the largest turbines in the world at the moment. And China is still at a lower level, but it's installing larger volumes of those right now. But also, China itself is installing the largest turbine, individual turbine potentially, but still the largest turbine. Now, what does this dynamic tell you? We can talk for hours on this particular point, but it tells you that you don't really know quite, we've talked a lot about vessels, you don't quite know what your vessel demand's going to be, what kind of vessels you need to actually make this happen. You don't know what kind of port infrastructure you're going to require to make this happen. You don't quite know who your supplier is going to be in the future and how that's going to work. And you also don't know whether things are going to be local or Chinese simplistically, right, essentially. Right? And that's actually quite a challenge for an industry that's supposedly recalibrating, thinking about value over volume, etc. You still have a lot of open questions about deliverability in that sense. Just one example, but it's a useful one. Now, despite that, though, and while we have done, I mean, you saw the 30% downgrade just by 2030, this chart goes out a full decade, down to 2035 or so, we are expecting to see significant growth overall in the market. Yeah? That growth is quite spread out. China still creates large volumes. But if you break out this piece here and you look at over here, so ex-mainland China, you're seeing a really strong growth story in Europe over the next decade. And a lot of these markets, it's pretty well known what's going to happen, really. I mean, a lot of leasing's already happened, a lot of deliverability is already starting to be secured, etc. And you've got the UK, large portion here, and then you've got other European countries like Germany and newer places like Poland, etc., that are going to be driving this particular area. Asia is important, but anyone who's worked out in Asia and tried to deliver these projects have obviously experienced places like Taiwan, which have come up against a number of areas, Japan, which has a bit of a stop and start moment, etc. And some of the larger countries like Australia, let's just say Australasia rather than Asia, etc. But those are much larger but future opportunities. Asia still stays a more peripheral in relative terms, excluding mainland China, as market.
David?
Yeah. Hi.
I'm looking at UK, rest of Europe, and we're not building out the grid anywhere near the rate it seems to me to make this feasible. Have you factored that in, and is it a big risk concern? Any thoughts around that?
Yeah, so as much as you can factor it in, right? So you obviously don't always know what's going to happen once people do it, but countries have got plans, and those plans are meant to be moving forward, and somewhere like the UK is actually pretty well coordinated in terms of what it wants to do. The timelines are obviously the big questions, right? And I'm actually, for the UK as an example, I'm going to talk later, classic, I'm going to talk later about ScotWind and the challenges around that, and one of those is just to get connected in the first place, right? So ScotWind makes up half the UK pipeline, right, in terms of gigawatts, but how much of that's genuinely going to come on? Well, not that much in this time frame is the first point, right? There's still quite a long timeline, massively delayed compared to what it would be, but also because they can't even get a connection, essentially. So we do factor those sorts of things in, but we don't model, if you see what I mean, this in great depth, the transmission network. We assume what people are saying, blah, 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 the investment timelines make sense. But Germany, again, classic problem as well. You know, Ørsted's got a project that's not connected, still earning money, but it's not connected. Depends on which side of which side you are on, right? I mean, you're trying to make a commercial project, you still get paid. But
I think it's a valid point. I was going to raise it on the side of floating wind. I think a lot of that confidence in when it's going to be delivered is not so much down to the technology and supply chain. There's an element of that, but I think certainly if you focus on the UK, developers are just seeing that it's not that we don't want it to deliver by 2030.
No.
We just can't.
Yeah.
But that's why we're saying our expectations are that you're now falling into the later into the 30s. It's just the grid connection dates that we were expecting never materialised, and the reality then is in the UK you can't build a wind farm without grid connection.
It's true.
So there isn't. Certainly, very UK centric. That is one of the key drivers for why we say floating wind will be delayed. We just can't connect them.
Yeah. No, I understand that, and then I would argue though for floating wind on top of that is obviously getting the finance you need. Not everyone's in a position to do that, which adds a layer of uncertainty, should we say, to the problem. But there are physical and financial struggles. But they, in terms of our outlook, in that sense, those projects don't make as much of an inroad in here because we have many other large-scale, essentially, projects still to deliver in the UK, in particular. Sorry, there are many other markets to talk about, but in particular the UK. Please, yeah.
The very small yellow sliver on that chart of USA, is that simply the Trump effect, or is it something else going on there? Because obviously, he's looking around forever.
Trump. No, it's Trump. Here. It's a fair point. I cannot predict that, I'm afraid. But no, it is essentially the Trump effect, right? And it's something that we were very careful of not just to sort of delete, right, in that sense, because it's not very fair on a process that's open. We've obviously downgraded our expectations. There is obviously already something in the water, smaller volumes. But even some of the ones that are 90% done are now being called into question, and it's obviously very hard to predict what will ultimately happen. But yes, it depends. I mean, if you have a choice, don't. I think it's probably the situation for the US right now. It doesn't make much sense.
It'd be a bold developer.
Sorry?
It'd be a bold developer at any point going back invested in the US.
Yes.
4 years later, you might get a slight charge.
True. I mean, people still have some of their leases, and they are still considering it as part of their longer-term portfolio, but it all costs money to look after, right? In that sense. Yes.
Underpinning that data really is there any thought into that in terms of the demand and usage as to why that end use is there, or is it just we're saying we're going to do that, or is it sort of electrification of the world and the country built into that demand growth, data centers and the like?
Okay, good question. So I guess that's the difference between a bottom-up and a top-down approach, right? Because You could always argue that wind makes so much sense in the US because it's gigawatt scale, it's the only thing that will happen, and so therefore, you know, from a top-down perspective, it makes absolute sense, right? But the way we do things is bottom-up. So we look at every single project individually, we look at its maturity, we score every project on a project certainty criteria, so we give it 10 or so, 11 or so different criteria that we score it on in terms of its likelihood to take FID. One of those is the demand side, but it's only one of 10 or 11 or so factors that we take into consideration. There are, you know, to do a demand-driven view doesn't really work in that sense in my mind, right? That's not how we want to do things because we try and give a realistic picture. Does that make sense? Or is that what you were alluding to? Or?
I just wonder, you know, how it dovetails into, you're saying obviously the demand for oil and gas is in some respects, you know, tailing off as the years go, and we're seeing that the demand for the build-out for offshore wind and, you know, electrons is going up. I just wonder the direct correlation there must be a driver somewhere in behind that.
Yeah, so from a macro perspective, you're right, there is a driver, but I think, how do you say this? So for offshore wind, it's quite a specific niche area really, right? There are only going to be some countries in the world that genuinely offshore wind makes sense. There's obviously a bunch in Europe, the North Sea, etc. There are some countries like Taiwan because they haven't really got many options, etc. But actually, again, you come back to the US, they don't really need offshore wind. There are one or two places for sure, but realistically, there's so much other opportunity that you can create a model, you can force offshore wind into it, and you can model it and go, right, there's demand for it because of data centers, etc. But realistically, it comes down to who's incentivizing, who's supporting, who's driving it. It's going to be quite a select number of countries who are doing that. But yeah, offshore wind is great demand out there for it because it's one of the only real gigawatt scale opportunities, renewable opportunities out there. And, you can support it, and it's more base load, should we say, than some of the other tech that's out there. But I think it's very country specific in that sense. Still not sure I'm fully answering your question, but I hope that makes sense. Yeah. Well, time's flying. So here's the chart, I think, Neil, that you were asking around the developer's outlook. So essentially, if you've got a real outlook for spend, again, 2025, small spend year overall, so you're not seeing the activity that you might expect. But that's really ramping up because of all the projects that are now being delivered. This is by contract award year, for clarity, in places like Europe, UK, little bits of Asia as well, etc. This is excluding mainland China. And it's resulting really in two things. One, a significant ramp up, right? And of course, questions around deliverability need to be answered in that time frame. But it is with a group of very, what I would call, serious investors, right, who've put money aside for this and are looking to deliver this opportunity, right? And as we talked about, as I was answering the question before, you still have a Total Energies, you've got an RWE, etc., who've been very smart, very focused in terms of how they deliver things. This, I think, is a smart kind of combination as well of businesses, of existing cash flow and new growth, and the money's been put aside for that. That's ready to go. You know, these guys, different investors, longer term, this is Poland, et cetera, et cetera. So they all have a very good story to tell, but if you're looking for who's spending that money, that's the ones who are expecting to spend the billions going forward. Very conscious of time, so I won't spend too much time on the key takeaways, right? But if you think about, there's a series of challenges, expecting still significant growth because companies are recalibrating and refocusing how they deliver that growth. Reduced floating wind opportunity as an example, but more de-risked portfolios in general. With Europe really, 5x growth also that we're expecting there in the next decade, which is going to create a real investment opportunity for folks. I don't know if you switched around the pack or do I? Oh, you have. Look at that. Sorry. How did I doubt Gareth? Yes, please.
Thank you. Really insightful presentation. So,
but.
No, but. I'm really interested that you still sort of have that forecast of 50 gigawatts or so coming through 2035 or so, I think I saw from the slide. You mentioned not much of that floating. So my background is I took Greenvolt to CFD, so
I thought I recognised the phrase. Yeah.
And I don't see the learning rates in floating that, for example, are in the DESNES, because we don't have any other projects.
No.
What else is coming at £200 a megawatt hour?
Yeah.
Not a lot.
No.
So then, do you see that 50 gigawatts of overall offshore in 2035 being dependent on fairly optimistic learning rates continuing to be available? And if so, what do you think of the pivots then? Because it's pretty well commoditized fixed rate, isn't it? It's pretty there, unless we look at Asian suppliers, I guess.
Yeah, but are you referring to the floating wind sector here? Because
I'm thinking all together, but also floating, yeah.
Okay, so I would argue you've partly answered your own question there, which is there aren't that many new learning curves to go down in terms of the fixed bottom. Obviously, you can recalibrate things, do more things efficiently, which is what these folks are working through. And I think you are seeing, reduced costs, more focus on delivery. And I think even the Greenvolt team, right, they're so focused on delivery. And I think that maybe got lost a little bit. That efficiency factor didn't need to be counted because you always just relied on this lovely little downward slope. You can't rely on the downward slope. So from what I've seen, there is significant more focus on essentially doing things as efficiently as possible, just to squeeze out that little bit extra margin. How much more of a learning curve is a good question, I don't know. But there is definitely a lot of effort being put into that. Which means resources taken away from other things, resources taken away from new markets, resources taken away from new technologies, etc., which is one of the reasons we are a little bit more downbeat on things like floating wind, because no one's got the time to spend on something which essentially feels way too far away for an investor's investment profile, or time frame.
Hard to see UK government appetite doing another Greenvolt or bigger on the CFD in the next 3 to 5 years, maybe.
Yeah. No, it's fair. I mean, they're pushing though, right? They're pushing in, talk about the UK in just a second, but in terms of what we were expecting to see the next CFD round, in terms of how favourable they are trying to be to all the different types of technologies. And they're also, I mean, if you saw the statement that came out around what the GB Energy strategic priority should be, so, investment company that the UK government set up, it should be all about essentially taking these riskier ventures, owning them, and essentially driving down costs within them, and then not leaving maybe, but that's how you can realise some value. Obviously, it depends on how that ultimately is going to run. But that's what the UK government seems to want to do: is interventionist style, almost private equity backed, drive into the energy sector, reduce costs, and make it more competitive for the UK consumer. How those strategic priorities then ultimately get implemented will be Dan McGrail's kind of job, but. Yeah, that's part of the strategy, and they're trying to do that left, right, and centre, right?
It's not very much money, though, is it? I mean, it's 1/3 of Total's annual capex as their entire capitalisation. What have we got left? 5 billion.
No, true, but you probably have an outsized influence in terms of what happens, right? It's like an Elliott Management Capital ever sitting on BP's, board now. Essentially, it's going to have a massive impact in terms of how the whole company gets run. It's the same kind of idea.
So the UK government will join projects and make them more efficient.
One of those two things is true. I'm joking. I'm sorry. Let me carry on, because I think I'm already almost out of time, and I haven't even talked about the UK. So I will skim through these slides quickly and hopefully. Oh yes.
On the wind energy.
Yeah.
Is there any influence on when green hydrogen will become commercially available? Is there not going to be an uptick there, or you show a straight line continuous growth, but is there nothing there that's going to recognise that?
Yeah.
Solidify the position on wind.
So in the next, so I'll talk about hydrogen very briefly. I'll do it very, very briefly now, I think, but I'll talk about it here. The point there is that green hydrogen is far too small a volume to have an impact on this, right? I'll talk about it later, but things like data centers are more likely to have a bigger impact than green hydrogen in terms of electricity demand. The question becomes what the UK government decides is the coupling of those two sectors, the electrification and hydrogen side of things, and that's obviously down to the grid storage build out, the questions around the value and the role that hydrogen can play in terms of combination with electrification. And so can you start to store excess wind power, blah, 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 etc. It doesn't necessarily create a new demand center. It helps to shift demand in that sense.
Solidify this.
Yes, that's the challenge. Right, super quick then. I think I am already in theory over time, so I will Scooby-Doo straight run through it. UK offshore wind, we were looking so good back in 2019 when we agreed as a government with the industry to target 30 gigawatts by 2030. The problem is the UK government is so focused on offshore wind as one of its key solutions to achieving net zero, and has so over time increased the target of what it wants to achieve and how it wants to get there. Which means we've gone from 30 gigawatts to now a 43 to 50 gigawatt target in offshore wind. That is nice, but it then comes down to deliverability, which is one thing we've been talking about quite a bit today. And just very simplistically, one of the things we are seeing is we've got a nice upward trajectory getting us close to 25 to 30 or so gigawatts. We have very clear line of sight of that. But what we need to have is a build out of somewhere between 8 to 10 gigawatts per year, right? And we need the next couple of CFD rounds in particular, so that's your contract for different rounds, which helps underwrite your projects essentially, to run very smoothly and get those volumes through. So it is a very efficient machine that needs to run in the next few years, almost, as simple as that, to be able to get projects through the door, to get them comfortable, financeable, and then deliverable. So it's a real challenge that the UK government has set itself. A big focus has therefore been on AR7. So this is the next CFD round, which is, I think, officially closed, and we'll get the results at the end of the year or early next year. Because what we've gone through is a period of volume getting pushed through at a lower strike price, essentially. And then we had this year, 2023, cost inflation year, etc., where things really kicked off. And the government did react, and nobody bid in, so there was no volume. And then we had some recalibration, uptick in strike price, more volumes, some rebid volumes coming in. But you're going to have to really get up towards here in terms of volume if you really want to start delivering the opportunity that the UK wants to achieve. And that's the challenge, is they're starting to recalibrate a bit more, recognizing the journey offshore wind has been on, but actually the volume needed is hugely uncertain. And the problem is, in advance of this, so many different changes have been made to the regime, how you get incentivized, what happens, that there's so much uncertainty as to what the bidding outcome here will be. One of the bigger ones, for example, is unconsented projects can get involved. Obviously lots of different ways, definitions of what that ultimately means. But suddenly your volume of projects that of different levels of maturity start to bid into a CFD round, which makes things very complicated for someone to understand. Where do you sit in the merit order and why, etc. And it increases the risk for the government, because you're going to start to give CFDs to projects that may never get delivered. So I'm skipping through these slides, and hopefully if we can get to questions as well. I talked about ScotWind. I'm not going to do this slide too long because there's so much more to talk about ScotWind. Half of the UK pipeline, 2 gigawatts has only been granted consent. That's the West Orkney project, I believe, which includes Total. The story here is really twofold. One is, ultimately, there's a massive pipeline, but it needs to go through a series of hurdles to be able to get essentially A, consented, and then B, go in for CFD, and then get delivered, etc. So the time frames we shouldn't underestimate, right? ScotWind's 3.5 years old, and we've only got 2 gigawatts consented. It's not necessarily bad. It's just, people haven't spent huge money. They spent a little bit of money, and they've got through the first few stage gates, but we're still a long way away from realistically delivering the ScotWind volume. And that includes the fact that we've got those more bigger bottlenecks, such as connectivity to the grid in the first place. So big volumes needed. Problem is, can you get the big volumes through? Simplistically, that's what I'm trying to say. We're predicting that the UK will miss its target. We'll get a couple of gigawatts away from the range, because actually there is a decent line of sight. There's decent volume out there. We're expecting a good CFD outcome. And that will really start to kick off a really very interesting EPCI spend well, I mean, you can tell projects get sanctioned and delivered at different times, which is why you get the kind of classic infrastructure curve here. But we're expecting quite a significant bill, about 200 billion or so of US dollars in the next 5 years. Hydrogen. I'll do these slides quickly. Hydrogen. UK, it was a good question about hydrogen in terms of its place, essentially. Hydrogen is very interesting in the UK because, again, in Europe, same as it is in offshore wind, UK is a leader, right? It has the largest pipeline. And a lot of that's driven by CCS enabled, so blue hydrogen rather than the green hydrogen. That's much smaller volume. But it actually puts it in a good place to kickstart a hydrogen economy. The problem is the UK system has really very slow, A, government processes, but B, also permitting and construction kind of risk essentially associated with it, which means many projects that want to move things forward have really struggled, right? What should be simple is not simple. Hydrogen allocation rounds, which are essentially the CFDs of hydrogen, while sort of 2 billion or so of money has been allocated, no FIDs have taken place. So these are the green projects, essentially. So while we've got this wonderful government-led process, et cetera, meant to move small-scale projects forward, none of them have taken FID. And future processes have so far fallen short. There's a lot more to talk about that, but I'll just say it's fallen short for now. And so when an industry is struggling and it's not quite finding its place and the government, isn't giving it the focus it needs, you start to see competition with other infrastructure. And this is specifically a comment to the BP Teesside project, where you're starting to see a data center being potentially built instead. Right? So what's more strategically important for the government, hydrogen or data centers? And so essentially, so we risk every project. We do a similar thing to offshore wind. We go in and we risk every single individual project in terms of its deliverability, its ability to reach FID, et cetera. We're about 3.2 gigawatts short of an 8.5 gigawatt lower heating value target for the UK, right? That in itself is a problem in terms of deliverability. But the bigger problem is consistency going forward in terms of what is the role of hydrogen and what are we going to do with it. We need consistency in terms of hydrogen allocation rounds, and we're missing a strategy. The strategy needs to be updated, which is what the government said it would do, but we're still waiting. It is probably already autumn in that sense. So when in autumn do we expect to see a new strategy? Probably end of year. I think they usually like to update their review of the sector just before Christmas. So we expect to see, I'm sure, something by then. But ultimately, there is a strategy missing, and there we'll likely see a better coupling with electrification, a better focus on value for money for the British economy, et cetera, which my expectation is there'll be very focused use of hydrogen and a much reduced overall ambition. CCS is slightly different in that there's a lot of progress and commitment in this space, which also links together with hydrogen, in fact, as I was talking about the blue type of hydrogen story, because we've actually had progress. Right? CCS has had many stops and starts in the UK, but actually we've seen progress. And the reason is because the government is really committed to trying to make a few key clusters work, simplistically. It's put together 222 billion in terms of money to spend and support. That is essentially a subsidy. It's developed business models so people understand the risks and how they're going to get remunerated and how you transport. So you essentially pay a TNS, transport and storage fee, to be able to get your CO2. So it's starting to sound like a real market, essentially, which is really interesting. The trouble is, and sorry, I am rushing a little bit, the trouble is essentially that it's all, once again, a government-led process, which is taking a long time. And because it's a new market you're trying to create, it's not hitting the timelines you would expect. And I don't think that's unusual, because whenever the government tries to do something, it will take time. So we're going to miss our key targets. We're going to miss the ability to put 20 to 30 million tons by 2030 in the ground. Or certainly the argument is it's capture, but we can only really put it underground. And so, while we've signed a few while a few FIDs have taken place on the key storage, the TNS side of things, only one capture project has properly signed an agreement. We don't really have that many other capture projects to feed into these storage sites, which is a problem when you're trying to underwrite, essentially, these projects that have taken FID. And the scope of what happens next is essentially an unknown. We don't know what's going to happen with some of the other business models. So each business model essentially is for for example, there's an industrial business model, etc. There's also one that needs to be done for imports. Imports could be a big one. The UK could become the rubbish bin, essentially, of Europe, but it hasn't got that opportunity just yet. So. And then, essentially, while you've got two clusters that look better in that sense, because they're fully government supported, this is not Norway where the government pays for everything, but it's still a pretty good business model overall. Majority of any other project that's out there is essentially relying on a real market to develop outside of the government track. And that's a problem, because right now we have no idea how that's going to look. Happy to talk about more of that, but that's the key issue for CCS. So UK offshore wind, going to miss its target, but still massive growth, 63 gigawatts by 2035 even, so just 5 years later, we're actually going to continue to see the growth. A lot hanging in my mind on this AR7 process, because it's going to show whether all these changes have made a difference at all or not, and what's going to happen with the volumes. We need to think about hydrogen CCS differently to all this. They play a more marginal role, a very interesting role in the UK, but they're emerging technologies that are government-led, and there's a lot still to do. Any questions? Good.
We are going to have to wrap up. We've got about 10 more minutes before about 100 students come barging in, potentially. A massive thank you to you. Of all the events this week, both of them, this has been my favourite one. Great questions today. Everything you've seen will be sent out to you. Like I said, we're doing a recording. We do have about 10 minutes, so if you do want to have a chat with any of the team, still grab a coffee, finish off a bit of food whilst we pack down. Everything you've seen today, in one way or another, has been derived from some of our solutions or from consulting. And hopefully you've got a taster of the minds and intelligence that we offer at Westwood. So if you do want to have further discussions, either ask us now, or there's feedback forms which I'd love to hear from you from anyway on content, or you can just drop us a line separately. But thank you to all the presenters. Great job today. And that's it. We're off to Aberdeen tomorrow for another 100 people. Have a great day. Thank you very much.